and we're looking forward to a good day today. We have two papers. Everything today will be in this room. We have two paper sessions, and then we have a panel at about 12:20 on looking at the long-lasting effects of COVID on the downtowns and the municipal finance. I want to renew my welcome on behalf of my colleagues at WashU Olin Business School, the Brandeis Rosenberg Institute of something or other, and the Brandeis International Business School, Rosenberg Institute of Global Finance. We had to make the type small to fit all that in. And the Harris School of Public Policy at the University of Chicago. And I also want to renew my thanks to Hao-En Chen, Megan Waring, Stephanie Sensula, Bree Nicker, and the others on our staff who've helped pull this off with such skill and efficiency. Our moderator for the first session this morning is Steve Winterstein. Alpha Ledger, is that the name of your new firm? No. That's your old firm. So what new firm is Stephen Winterstein LLC or something? SPW. All right, Steve Winterstein.
Thank you, David. I had to lower the mic here. So today, if we have Stefan Gissler presenting a paper called, and I was, you get these papers and there's, the titles can be bland sometime, even though the content is very interesting. But Pushing Bonds Over the Edge, it sounds like a terrifying title, but Pushing Bonds Over the Edge, Investor Demand and Municipal Bond Liquidity. John Bagley at the MSRB, Stefan Gissler at the Federal Reserve, and Kent Haichu at E&Y. And so I'm going to ask, and Ivan Ivanov at the Federal Reserve of Chicago. So we're going to invite Stefan up and present the paper, and Kevin Bain will be the discussant afterwards. The floor is yours. Thank you.
All right. Thank you very much for having us. So the usual disclaimer applies. These are my views, not of the Federal Reserve. And let me actually start off with something that happened way after we started this project, which was the banking stress last March. And in the aftermath of SVB's failure, BlackRock was supposed to sell SVB's large muni bond portfolio. And this wasn't seen to be an easy feast. And the bond buyer, for example, states that those bonds are very difficult to sell because the holdings consist of structure, not credit risk, which likely will require deep concessions given liquidity and the US de minimis risk. So that quote actually summarizes our paper pretty well. What we do is we document that the de minimis risk leads to illiquidity, and then we actually show how this happens. We show that it's mainly institutional investors selling the bonds. But let me not do the bond buyer the job of describing our paper and give you a better high-level summary of it. So what's the institutional setting here? Well, interest income on municipal bonds is tax exempt. However, gains from trading are not. So each bond has a threshold, and if you buy a bond on the secondary market below that threshold and either hold it to maturity or sell it afterwards, you incur ordinary income and you have to pay ordinary income taxes. Now, why is this a risk? Well, municipal bond investors are highly tax sensitive. So on the one side, we have retail investors that are often in the highest income tax brackets. On the other side, the largest institutional investors, which are muni mutual funds, often cannot incur tax liabilities. So given that background, we take trading data and basically look around the de minimis threshold, how several trading statistics evolve. We then supplement the data with quarterly institutional holdings to see how the largest institutional investors behave. And those are mutual funds, closed-end funds, property and casualty insurers, life insurers, and the largest commercial banks. And the main findings that we're going to have are that trading really plummets once bonds cross the de minimis threshold. Trading volume and trade size drop very closely to the threshold, and all this behavior is not the same across all bonds. It mainly depends on a bond's interest sensitivity. There's a lot more trading still going on close to the threshold if a bond is less interest sensitive. If a bond is highly interest sensitive, the sell-off occurs way earlier. Now, what's driving all this? Well, it's mainly the institutional investors selling their entire positions. I'm going to show you that once a bond moves towards the de minimis threshold, the largest holders, which are mutual funds, sell their entire positions and move out of the market. Their behavior also depends on the interest sensitivity of the bonds. They wait a little bit longer if a bond is less interest sensitive. While this is all in the cross-section, in one of the last exercises, we'll then look at the time series dimension of the risk and show you that it's not stable over time. Monetary policy, especially contractionary policy, actually amplifies de minimis risk over the cycle. So in the remainder of the presentation, I'll just go into more detail of these points. But before this, let me give you either a reminder or a little primer on what the de minimis threshold actually is. So obviously, from tax-exempt bond, interest income is tax-exempt. But the IRS says, well, if you get gains from trading municipal bonds, you have ordinary income and you have to pay taxes on that. So they set a threshold, which is a so-called de minimis threshold, and say, if you buy a bond below that, you will have to pay taxes once you realize the gains. They can either be realized once you sell them in the secondary market again at a higher price, or if you hold the bonds until maturity. The general formula the IRS sets is basically the so-called adjusted offering price minus 25 basis points for each year of remaining maturity. So the adjusted offering price is very simple to calculate if a bond was issued at par. It is simply the par price. So for example, if you have a bond that was issued at par and has 5 years of remaining maturity, the de minimis threshold is just 98.75. If you have an original issue discount bond, it's a little bit more complicated, but more or less it's the same style and feature, right? So what we do is we calculate for each bond that was traded between 2010 and 2022, for each bond in each year, the de minimis threshold. Then we take, as everyone else in this room, mainly for the presentation, the MSRB data. We aggregate it to the weekly level. We calculate average weekly trade prices. And then we supplement this data with quarterly institutional holdings data coming from EMAX. They have data on mutual funds, property and casualty insurer, life insurer, and closed-end funds. And now we also use confidential supervisory data from the Federal Reserve's Y14 that covers all the commercial bank muni holdings above $100 billion. So with this, we basically then just look at several trade statistics around the de minimis threshold. And the first piece of evidence that the de minimis threshold actually leads to illiquidity can be seen by simply looking at a histogram of our data. So what you see here is the frequency we have of trade prices in our sample along the distance to the de minimis threshold. So on the x-axis, you basically see the average trade price minus the de minimis threshold. Positive numbers means that the bond was traded above the threshold, and negative numbers mean that the bond was traded below the threshold. And what you see is that once you approach the de minimis threshold, first trading frequency increases and then pretty quickly drops off and never recovers. Now, how quick that drop-off is and when the trading frequency really disappears depends on the interest sensitivity of a bond. So what I don't show here, but what we do in the paper is we divide the sample of bonds with a duration above and below the median. And for high duration bonds, the sell-off or the trading frequency actually resembles that picture. And for bonds with a low duration, you have a lot more trading still going on between 1% and 2% above the de minimis threshold. Now, looking at other trading statistics, we also see quite a big deterioration approaching the de minimis threshold. This slide shows you on the left the traded volume of a bond during a week, and on the right, the average trade size of a bond during the week. And you see that both of those variables decline pretty rapidly once you move to the de minimis threshold. Now, one caveat to have in mind when looking at these charts is they are conditional on a bond actually being traded. So while it may look like that these statistics recover once you cross the threshold, bear in mind that I just showed you that there are barely any trades to begin with. However, the trades that there are really expensive, as you can see here. So what we do here is we calculate for each transaction the markups, meaning that we construct complete intermediation chains and then just take the difference between the last sale from a dealer to a customer and the very first sale in the chain from a customer to a dealer. And what you see is that irrespective of the trade size, trading costs actually increase threefold for every trader once a bond has crossed the de minimis threshold. Now, what is going on here? Well, the first suspect to look to are mutual funds. They are the largest holder of municipal bond and one of the largest participants in the secondary market. And as a whole, they are actually very large net sellers of muni bonds once they approach the threshold. What you see in this graph is just simply net buying of the muni mutual fund industry, again, across different buckets with the distance to the minimum threshold. And you see that this picture basically resembles the trading frequency graph I showed you earlier on. So once you move toward the threshold, the mutual fund industry starts selling their entire positions. They don't sell gradually. If a mutual fund sells, they sell their entire position. Again, for them, the timing of the sale depends on the interest sensitivity of a bond. If we take bonds with a low duration, the selling is way closer to the minimum threshold. Now, what does this, and we don't show it here, but for most of the other institutional investors, the picture actually looks exactly the same. I could show you the picture for commercial banks. It looks like this. Property casualty insurers, it looks like this. Closed-end funds, it looks like this. The only investors we don't see this behavior are life insurance companies, which we usually think of as our very typical buy and hold investor. Now, all this selling by institutional investors actually has a large effect as well on retail investors. What we show in this table is we run our measure of markups, so trading costs, on a dummy that is 1 if the institutional investors have sold the majority of their position in the previous quarter, and then interacted with the distance to the de minimis threshold. And what you see is that once a bond crosses the threshold, trading costs not only increase unconditionally, as I showed you before, but for small and medium trades, there's an additional increase in trading costs of about 10 to 17 basis points. So selling by institutional investors has a large externality for retail investors and medium trades. In another exercise, we're addressing a 2010 paper by Ang that basically made the claim of, in order to explain the large increase in yield that you observe once a bond crosses the threshold, you would need an implicit tax rate of about 100%. What we do here is that we show that it's most likely illiquidity driving this. In order to make that claim, we divide the sample in turnover and then basically take a dummy if a bond was in the lowest quartile of turnover, and again interacted with our distance to the minimum threshold. And what you see is that the effect is by far largest for the most illiquid bonds. And we therefore think it's less likely that it's 100% implicit tax rate, and most likely the expected illiquidity of the institution of those municipal bonds that drives institutional investors to sell those bonds in order not to incur those high trading costs and in order not to be forced to sell those bonds in the market when it's very, very illiquid. Now, while these are all things in the cross-section, let me spend the last exercise on the time series dimension of the de minimis risk. Obviously, as monetary policy increases rates, bond prices go down. And what you see in this graph is a time series of bonds traded in the region where they are basically at the risk of the sell-off. So between the de minimis threshold and 4 percentage points above. This is even a very tight spread, as you've seen. If we would increase this by 1 or 2 more basis points to 5 and 6, we would still call them that those are bonds at risk. And even though it's not graphed here, you may be able to see that it really resembles the path of interest rates over time. And in times of contractionary monetary policy, as we are in right now, sometimes over 30% of bonds traded in a given week are actually bonds very close to the de minimis threshold. So I hope I convinced you that the de minimis threshold actually leads to illiquidity in the secondary bond market, and that the mechanism behind this is institutional investors expecting illiquidity, expecting a large increase in trading costs, and therefore moving out of the market. Now let me close with one thing that I haven't answered so far. Who is actually buying that stuff? And I showed you data on all the institutional investors that we can observe. So this is a very large caveat, and it seems that anecdotal evidence points toward either small banks buying those things or hedge funds buying those. Going back to the example I mentioned before with BlackRock selling SVB's bond portfolio, apparently the sale went pretty smooth. And anecdotally, it seems it was institutional investors moving in and buying those bonds. The problem here is we don't have data to observe hedge funds. On this rather not so good note, thank you very much.
Thank you, Stefan. And Kevin Bain, hi Kevin, is going to address the paper and give us his thoughts. Thanks, Kevin. City of Detroit, by the way.
All right, well, good morning, everyone, and thank you, Stefan, for the wonderful presentation, to all the authors for a great paper. My name's Kevin Bain. I'm the debt manager for the City of Detroit, and obviously these are my own thoughts, not the city's. So I actually started my career in debt capital markets at Citigroup, issuing bonds for corporates, which were taxable bonds, of course, and then I joined the city 2.5 years ago, where I started issuing tax-exempt bonds. And immediately I had these questions about why the tax-exempt bond markets were peculiar and different than the taxable markets. And this paper actually answers a lot of my questions. Also begs more questions. And so that's what I'm going to talk about today. To summarize some of the key findings that resonated with me the most, not necessarily the author's major findings, but for me, is one, the impact on liquidity, and two, the steep sell-off in these bonds as they approach the de minimis price. Not at the de minimis price, but as it gets even just relatively close. Third, this acceptability to economic and monetary policy decisions, which is what Stefan was leaving off on. Here, the red line is actually the Fed funds rate, so you can see the stark sell-off of bonds. And then last, what is the purpose of this rule and why that is causing this distortion? So the paper does address it a little bit. It says that the rules passed in 1993, so it's the same. Me and it are the same age. I'm a couple months older, so I'm a little bit wiser. But the goal was not really, it was not part of the major goal. And the estimates, it's not even one of the estimates in the Congressional Budget Office's estimates. So although a lot of people here probably know how bonds price, just a quick run through for the taxable bond markets. Issuers set the par value that they're going to sell. They build the order book with investors. If there's a lot of a demand, we can drive down the interest rates and lower our borrowing cost. And then ultimately we set the yield and the coupon set at that yield. So the characteristics of a taxable bond is that the issuer sets the par value and that determines the issuance size. The market determines the yield, which sets the coupon. The tax-exempt bond market operates differently, though. For us, we actually set the coupons ahead of time. The market standard is that we use 5% coupons. There are sometimes lower coupons based on your rating or the interest rate environment. But the 5% coupons are the standard. I've asked many times why this is, and usually my answer is it's just market standard. I think there are probably a lot of factors, but this discount rule has to be one of them. And I know that because when I do sell bonds and I go to investors, we had to set that 5% coupon, which is much higher than yield, in order to offer investors protection that these bonds will never fall into the discount territory where they become highly illiquid. So the results are that the coupons don't equal our bond yields, which means that the issuance size does not equal par value. And to me, this is market distorting because especially when a lot of our bonds are approved by voters and voters approve the size of the bonds, we have to decide, are we setting par value or are we setting the issuance size? So the summary is that in the tax-exempt bond market in comparison to taxables, the issuer sets the par value and the coupon. The market sets the yield, which then determines the issuance size. So I joined the city right in the middle of a bond transaction in 2021. We sold $175 million of bonds, and we actually had a tax-exempt series and a taxable series, which makes for a great comparison. Our tax-exempt series had about a 3.369% yield, but our coupons were the market standard of 5%. Our long-term bonds actually were at 4% coupons because interest rates were so low due to, and then interest rate sensitivity. But anyways, we had over $30 million of bond premium, which is pretty sizable for this size deal. In comparison, our taxable bond, $40 million, yield was 3.185%, coupon set to match the yield, and that's how much we received in proceeds, less the cost of issuance. I can return to this later if there's questions, but what I'm showing here is the rows of the maturities and the coupons. You can see they're all 5 or 4%, and then the yield columns show that our yields are in the 2%, which is so far off from the coupons. And here, what to look at is the price column, because if you were pricing a bond at par, all those would be 100. But instead, we're actually pricing about 25% premiums at this bond. So to put it in context, our 2021 deal took place at really historical market lows. We had an optimal timing for this bond. We were very happy about it. As it just so happens, I also priced a bond last week. Thankfully, there was a really good inflation report, and we were able to accelerate our bond deal because I was very nervous about pricing a bond while standing up here at the same time. But now I have a great comparison to talk to you about. So as we're going into this deal, we obviously look at how our bonds are trading in the secondary market. And as it so happens, the bonds we issued in 2021, some of them are trading below the de minimis threshold at the bottom of the screen. Our 2021s that were issued at the 4% premium are now in the low 90s or high 80s and have become highly illiquid. This happened even though we offered the investors the protection of issuing the higher coupons. These were 4%, they weren't 5%. But keep in mind, the 4% coupon still generated 25% premiums for us. So if we had done the 5% coupons, we would have had really an extreme premium. So going into this deal, again, we actually had 3 series, 2 tax-exempt and 1 taxable. The first tax-exempt series of the $52.5 million was a little bit on the front end of the curve, so the yield was actually below 5%. But what's interesting is that even though it's below 5%, that wasn't enough for investors to accept the 5% standard coupon, and we actually had to increase our coupon to 5.25% or 6% in some cases. And what's interesting to me about that is that, again, even though we could get below 5% yield, we actually, based on our underwriters' feedback, didn't think we could sell those bonds because it would be just too close to par and too risky going into discount territory. The $25 million deal was more on the long end of the curve, so priced at 5.3% yield, and we had to do 6% coupons. Both of those priced with just a little bit of premium this time. But again, the taxable bond, very simple. Yield was 7.4%, set the coupon to match the yield. We received the $22.3 million after cost of issuance. So here you can see for this most recent tax-exempt series last week, is that our price is much closer to par. We have about, on average, a 6% premium. But my experience with this is, as I try to explain this, because I do have to explain everything that happens to public commenters and to city council. And so the question is, if the market widened 200, 300 basis points in this 2 years, why did our coupons only change 25 basis points or 100 basis points in some cases? That may sound like a win, but one day the rates will come down and they're going to ask us, why didn't our coupons come down more? Also very interesting to me, again, that even though our yield was under 5%, we still couldn't do that 5% coupon, and we had to increase our coupon. So it seems bizarre to me that coupons actually change the yield. You really, in a normal world, you wouldn't think that the coupon actually changes your yield, although it would obviously change your issuance size. But if we wanted to keep that 5% coupon, we would have had a higher yield and probably not been able to sell those bonds. And then secondly, I thought what was interesting is that in this high rate environment, due to monetary decisions, although our coupons didn't change much, the amount that we issued, our issuance size and our premium, did change a lot. And again, this gets confusing when we're trying to meet voter authorizations and we have to figure out, are we going to set par or are we going to set issuance? And that can get very confusing on one pricing day when you're trying, if you do decide to set at an issuance level, you have to actually decrease your par during the deal. So all in all, I just keep wondering, why do we even have this market complexity? And so my takeaways from, again, I thought the authors did a really great job, and I don't have a lot of feedback on how to improve their current scope, because I think that they really explored all the angles and had robust methods. But and just can't help correlating this to the primary market. So in the author's findings in the secondary market, we find that investor demand really decreases a lot, not at the price, the de minimis price, but before it. While in the primary market, we actually have to set our coupons well above the yield to do a bond at premium. So investors are asking for this protection the entire lifetime of the bond, at issuance and during secondary market trading, and really creating a level of liquidity. So two, the bonds are highly illiquid below that de minimis price in the secondary market. In the primary market, the bond yields are driving the coupons higher. So I can't even sell a bond with a coupon too close to my yield. It makes selling more difficult. And then lastly, the effect of monetary actions on both the secondary market and the primary market. And so my feedback is that I would love to see this research expanded into the primary market. I would particularly like to see how issuers deal with the issuance premiums in different ways. I think it might be interesting to compare how different coupon bonds trade. Again, in a normal world, you wouldn't really expect the coupon to affect trading. But we do see, since it does affect it in the primary market, maybe it does have an effect in the secondary market as well. And so I'd really like to question who benefits from this rule that's causing such market distortion. Because I would like to answer that if this rule does cause market distortion, then who's getting the benefit and what's the point of it? So again, thank you to the authors. I really enjoyed reading the paper. And as Stephen said, great title.
Stefan. So, Stefan, why don't you respond to Kevin's comments for a few minutes, and then we'll open it up to the audience.
All right. Well, what do
Here.
Okay.
There you
Perfect. Well, first of all, thank you very much. I think you fill the gap that is always asked of us, always when we present it. And there are a lot of economists that think like, oh, liquidity in the secondary market, who cares? So for people who don't intrinsically care about liquidity in the secondary market, the follow-up question is always, so what happens in the primary market? And I think you filled like a massive gap in our understanding how it distorts that market, and provide a very good starting point for us to think more about it. To what your suggestion of like more exercise, what we can do, I think it's very good the point with the coupons, looking at different coupon rates. When we started the project, we wanted to do it. Problem was interest rates were very low. So the 5% coupons, which are most of the bonds, were really far away from the de minimis threshold. Now, thankfully, the Federal Reserve have come to the rescue, and now those 5% bonds are very close to the threshold, and some of them under, so we should definitely revisit that. But again, thanks so much.
So I'm going to weigh in as a previous institutional buyer. I can say the observations are spot on in both cases, both with the paper and Kevin, your observations. I think that it would be interesting to pair this paper with Andy Calate's work on the acceleration of duration and around the market discount cutoff price, and how that duration becomes negatively convex. It accelerates to the downside. But having said that, I'll turn it over to the audience, and I have to call one of the authors, Kent Taishu.
Am I allowed to comment on my own paper?
You are.
Okay.
Can I
think
prevent
Kevin,
you?
I have an answer for Kevin. The beneficiaries are the mutual funds that are buying your bonds. Because the distorting effect that's not accounted for directly in the paper is the standard 10-year call, par call in the market. So in effect, you want to borrow for 30 years. The mutual funds are lending you money for only 10 years. because the coupon's really only locked in for 10 years at that point, or your yield's only locked in for 10 years. After 10 years, the yield kicks eventually to the coupon on the bonds. So you have a huge incentive, unless interest rates take off, of refinancing your debt at an unknown cost in 10 years. So effectively, the mutual funds have gotten a yield of 30 years, or somewhere between 10 and 30 years, because the index is all 5% coupons. So when you price to a spread, it's not the spread that's 30 years, it's the yield to worst on the 10-year. And so effectively, you're borrowing 30-year money at a price that doesn't reflect, or that reflects the likelihood that you're going to call the bonds out. And so the investors are getting a higher yield than they should. For example, there's a whole lot of reasons why muni issuers, and including Detroit, couldn't sell 10-year debt with a bullet maturity. Rating agencies don't like that. You've got rollover risk. You probably have statutory restrictions on your ability to have a big balloon payment due in 1 year. But it would be very interesting if the municipal market would start selling more 10-year bullet maturities and find out what the true 10-year cost of capital is, as opposed to selling 30-year bonds with a 10-year call that's going to force you to refinance your debt at an unknown interest rate on that date. So,
Thank you.
And my explanation of this to Ivan, I guess, is the reason why I'm listed as a co-author, because I didn't write a word of this thing. It's
Yes, Mike.
Mike Ivsick, Bancroft Capital. Appreciate the conversation. You said your dates when you were looking at the trading was between 2010 and 2022. Obviously, you've got a falling interest rate environment for pretty much the entire duration of that time period. So I'm curious, as your thoughts with the data that you looked at, what would you expect to see now that we're in a rising interest rate environment? Because obviously the de minimis, in a falling interest rate environment, the de minimis is going to be helped by the fact that bonds continue to gain in value. As it's gone the other way, you see Kevin's slide, and you see the difference in his pricing and what he was able to do. In the secondary, obviously, you're going to see those bonds sell off from premiums to $91. What do you anticipate if you were to do this in 3 to 5 years and look at the rising interest rate environment? What would you expect to see?
So the results are actually, well, as I said, before we started, we only had the decreasing rate environment. We started 2020 even, maybe, something like that. And obviously, once we started including more and more data, 2021, 2022, now even more recent quarters, the results just got stronger. So the results are perfectly robust, even in a low rate environment. But as you clearly mentioned, it's there are just less bonds traded close to that threshold. And the closer the higher the interest rates move, the more mass of trading you have going on. And now, as I mentioned to Kevin, now we even see 5% coupon bonds in this region. So I think if we move 30 years down the road, I'm not sure if I'm still working on the minimum rule in 30 years, but I still think the results will hold, and we will see the exact cyclicality that I showed in the last slide of just depending on the level or the increase in interest rate at the given time, you will see either maybe just 10% trading close to the threshold, or as we see right now, 30, 40% trading close to the threshold.
I got time for one more. Matt, I think you were one of the first guys with your hand up.
Yeah, thank you so much.
Make it quick. We got 3 minutes.
3 minutes. All right, I'll make sure I keep it under one. So generally speaking, when pricing a new issue deal, right, this is for you, Kevin. You mentioned about institutional accounts coming in for bonds, right? And generally the oversubscriptions in these maturities is what actually drive a lower interest rate or borrowing cost to the issuer. So my question to you is, why would issuers be focused on secondary trading as opposed to the actual cost of issuing the debt?
Yeah, thank you for the question. I mean, I think I know this from when I do go out into the bond market that investors express their concern if we're too close with coupon the yield that the bonds will fall into discount territory. So again, in 2021, we didn't really have these conversations. We really just went with the market standard, which was 5% coupon. So we didn't really have that experience. But in 2023, when our yields were so close to the 5% coupon, and I think a lot of people believe that interest rates are close to a peak and will be coming down soon. So they're not so worried about bonds going down too far in the future. But if it was just too close to par, then there's still the risk, especially in the short end of the curve, where it's an arbitrary rule, right? 25 basis points multiplied by years maturity. It could have been 50 basis points, 100 basis points, 10 basis points. I don't know why they chose 25. But at the short end of the curve, you really don't have much room to fall into discount territory below the de minimis pricing. So I think that, of course, investors care about buying bonds that are liquid, that they believe they can trade in the future, and they don't want to buy something that is at risk of becoming illiquid anytime soon. So I do think that it carries over. I do think that, there's institutional investors in here, so you can chime in. But I think people do care about whether they'll be able to trade in the future.
Thank you. We got to keep things moving here. I've been appointed the taskmaster, and so what we're going to do is move on to our next paper. So thank you guys very much. Well, I'm going to stay up here and introduce. I've been really, it's a privilege because I have really interesting titles that I'm moderating. The Complexity Yield Puzzle, a textual analysis of municipal bond disclosures, something that we're all interested in and something that's extremely important in governing costs of borrowing. So this paper, written by authors Michael Farrell from the University of Wisconsin-Milwaukee, Dermot Murphy from the University of Illinois in Chicago, and Marcus Painter from St. Louis University, and Guangli Zhang from St. Louis University. And I believe, Marcus, you are going to be presenting, so have at it.
All right, thank you. The effective transmission of information is going to be a joint activity between a sender and a receiver. And so if we think about the optimal way to have a financial market function, we need clear communication between the investors and those that are seeking the funds. So if you're going to communicate with these investors, one of our primary ways of doing that is through our disclosure. And we need to think about how to write that disclosure based on who could be the ultimate end holder of that investment. So it's still early in the morning, so I thought cartoons would be a good way to brighten up the day. So my extreme example of what our clientele in the muni market is kind of as follows. We're going to have a lot of a gradient in between who can be these, but one extreme might be a very professional institutional investor. You could think a portfolio manager at a muni bond mutual fund who has a wealth of resources to process a lot of information. They might have a team of analysts, and they themselves are going to have extensive investing experience. They want as much information about that bond as possible to process and to value that bond. The other end of the spectrum is going to be retail investors. They could be very intelligent, successful people. My example here, he works in medical equipment sales, so he's done very well for himself, so he's in a very high tax bracket, but has limited time, might have an advisor helping, but ultimately investing on the side. Going to have, especially compared to an institution, much lower bandwidth in terms of processing complex information. So if you look at a couple of different bonds, I pulled a couple from the city of Stillwater here. This is a relatively straightforward disclosure, just looking at the table of contents. You see how we might see a reaction from these investors. The institution will be happy to see what they have, but they might want even more information because they can have the bandwidth to process this. Whereas our retail investor might be satisfied with that straightforward disclosure, again, because they don't have so much time for any more extra information. But if you go and look at this is another bond I pulled from Stillwater that even just from the table of contents, you can see is much more complex, about twice the size. Now the institution's happy, so much to analyze, there's a lot of information here. The retail investor might struggle here. And then again, it's not because they don't understand the information. They might not have the bandwidth or the time to go through all of this. So they might just pull back from this specific bond. Now, we think this is a real issue in the muni space because of the lack of real straightforward policies in how these things are constructed. It's kind of like the Wild West when you're in these statements. There's no standard, management disclosure section. There's no risk section like you see in the public markets. So you see very large variation here. And now the SEC has become more vocal about this and concerned about the state of disclosure in the muni space. There's been some enforcement actions against both municipal advisors and issuers. But then there's also been pushback on standardizing these things from local governments and underwriters. So we have some tension here about what's going on in this space, and I think there's going to be effects on cost of capital because we have a market that's predominantly individual investors that are ultimately owning these things. So that gets to the research questions here. We have two main research questions. First, does the complexity of these statements actually have outcomes for the market? Does it affect cost of capital? And we find that it does. So we call this our complexity yield premium. It costs more to issue, or there's a higher associated cost to issue bonds that have more complex disclosures in the primary market. Now, this is driven by bonds that are more likely to have retail investor presence, as well as bonds that have less complementary information. So if they're unrated, for instance, you're going to see a higher premium. We don't have time to look at the secondary market today. We do look at it in the paper. We see that the more complex statements are associated with more volatility and a higher markup differential between retail and institutional investors in the secondary market. The second part of the paper is just trying to look at the characteristics of these official statements over time, which is where we uncover that puzzle that's in the title of the paper. We see a stark increase in the complexity over time, which we think is puzzling because these bonds typically cost more to issue if there is much more complexity in those statements. So we delve into why. We find suggestive evidence of a clientele effect catering to institutions specifically. And then we also find some evidence that increased regulatory oversight without a really standardized policy structure is also leading to this complexity. So a little bit more about these statements. I think everyone here is pretty familiar with them. But these are kind of our end-all, be-all of what we need to look at in the primary market for bonds. So there's not a lot of guidance on exactly what needs to be in here, except for we need to be complete, which means an investor should not have to research the bonds beyond what is available in this OS. All of our material information needs to be within this. And we get a lot of the contents that you care about, the maturity of the bond, the size, whether or not it has a credit rating. So we collect these from MSRB. They're posted on Emma, but we get the bulk download of them ever since they've been required to be posted on Emma from mid-2009 through 2019. And we're going to merge this with primary market data from Mergent. We end up with about 85,000 statements, which are, of course, associated with a lot more bonds, but we'll look at this at the issuance level. So then we need to measure the actual complexity here. We can't just look at the visual table of contents. We need to do it more systematically. So we're going to rely on some motivating literature, both from finance and the linguistics space. From the finance space, we think a lot about the overall volume of information, things like the number of pages and the word count of the document. And then there are a lot of different ways of thinking about the readability of a document from the linguistics literature. And we're going to create a composite index of these. So we didn't want to take too big of a stance on any one of these. What we're going to do is kind of take all of these and say, if they're all kind of trending towards complexity, that's going to be a complex document. We'll center it around 0, so that if you have a complex index score of 0, you're an average complexity in the sample. If you're 1, you're 1 standard deviation above, and it can go above or below. Thinking about some stats here, these things are usually about a couple hundred pages. On the low end, about 80 pages. A high end could be upwards of 200. The readability scores are typically at a grade level to think about. So like on the 25th percentile of these readability scores, you need about an undergraduate degree to understand them, roughly speaking. At the higher end, you need basically a PhD. So these things get pretty complex when you're getting towards the high end of the distribution. So I wanted to pull one excerpt just to show that it seems to be capturing complexity in a document. So this one is an official statement from the Massachusetts Health and Educational Facilities Authority. It's talking about the debt service fund a lot about how it might be redeemed through outstanding different pieces here. I'm not going to read the whole thing. I just wanted to show this is one sentence in the document. It's the run-on to end all run-ons. You see a lot of this within these types of complex statements, and we're picking up that in our index here. This one's 1.2 standard deviations above the average here. Now we want to see if this is associated with a higher cost of capital for investors in the primary market. Does it cost more to issue these things? So we look at yield spread. We're looking at this in a relatively standard regression framework with the typical bond controls and fixed effects. We look at it in several different ways. I just wanted to show that time series graph once again about that complexity yield premium. What this is telling us is how much more does it cost to issue one of these bonds if we had a 1 standard deviation increase in our complexity of these statements, and I'm showing it over years. So it's pretty stable, between about 4 basis points and close to 8. The full sample average is about 5 basis points. So that association, it's pretty economically significant. One way to think about this is we look at issuances with a disclosure complexity that's a half a standard deviation or more above the average. Collectively within those issuances, they pay about $1.4 billion more in issuance costs. That's over our sample here, but it's a pretty economically sizable magnitude for this complexity yield premium. So we want to look into ways of figuring out where this is the most important. A couple of hypotheses we look at is looking at where retail participation might vary. So we're looking at a clientele effect where we might have investors that might have that lower cognitive bandwidth to process these things. The other place we're going to look, and I'm just going to skip to results here, but looking at the second piece is where complementary information might be lacking. So we might not have a third-party credit source, or that third-party credit rating might not be as informative. So just skipping to the results here, we look at this complexity yield premium in interaction tests, but what I'm showing you here is the effect in settings where we have low institution versus high institution investment. So in states where we have with no tax privilege, we're going to have more institutional investors. So that's the red graph. The second one, we don't see an effect, whereas where there is tax privilege, we'll have more retail investors. We see that complexity premium. When we look at bank-qualified bonds, we have more institutions for those. Obviously, we'll have banks investing. There's no effect. When they're not bank-qualified, it's larger. We also pulled from Stefan's paper the de minimis threshold. Those bonds that are issued at a higher price are going to attract more institutional investors. We don't see the premium there. This negotiated one's actually flipped. So negotiated bonds have a special window in the primary market for retailers to invest. So we'd expect them to actually be participating directly in the primary market here. And we see the effects higher for those negotiated bonds. When we look at credit ratings, so these are bins, high grade, medium grade, low grade bonds, and then unrated. We see most of the effect is coming from those low and unrated bonds, where again, we're going to have less complementary information so that we'll have to rely more on the context of the official statement. So the second part of the paper, we're trying to document whether or not this is changing over time, and that's, again, where this puzzle comes from. We see that complexity has been drastically increasing over time. Again, it's costly to do this, so why is this happening? Why are they getting more and more complex if it's costing these municipalities more and more to issue these things? So we look at two hypotheses to try to explain why it's increasing over time. The first one we call the catering hypothesis. This is that complexity might be increasing in subsets of bonds that cater to institutions where this premium might not really exist. We find some mixed evidence of this. It's not particularly robust across different tests, but we see some evidence of it. But I'm going to skip to the regulatory burden hypothesis, which we think is a bit more robust. The idea here is that if there's increased regulatory burden for a municipality, they might just start to throw a lot more information into these statements to try not to get sued or dinged later on for omitting something. Again, because we don't have that standardized framework, they might just try to keep compiling more and more information into these documents. So the way we look at this is by exploiting regional variation in the number of SEC enforcement officers in regional offices. So between 2015 and 2017, there was a very drastic increase in the number of SEC officers due to a push by Mary Jo White. And there was large regional variation. Overall, the number of enforcement workers increased by 70% during this period. The Boston SEC office saw an increase by 150%, Fort Worth only 9%. So we're going to do a diff and diff here. We're going to sort our munis that are associated with states that have a high enforcement increase. So the Bostons of the world, if your bond is issued in Massachusetts, you're going to have a high enforcement sorting in our test. If your bond is issued in Texas, it's going to be a low enforcement, and we'll do that for all of the regional offices of the SEC. So let me just show you that over time. Again, the outcome here is how complex are these documents, and we're comparing the difference between the high enforcement states and the low enforcement states, the bonds that are issued in those states. They're not really different before about 2015. We see very insignificant results there. Around 2016 is when we see a stark increase, and we see much more complexity in the documents of munis that are issued in those high enforcement states. And again, it was 2015 to 2017, so we saw kind of a rollout of those enforcement workers. So we kind of see it gradually happen over time. The last thing we do is try to add some structure to these unstructured documents by doing some machine learning through what's called latent Dirichlet allocation. It's a topic modeling that uses textual analysis to group words that are very similar to each other. And then we as researchers assign what these groups look like within the documents. The 4 groups that we identify as the most prevalent within these documents are risk sections, bond description, cash flow, and legal. What comes out from doing this algorithm will tell us certain types of words that we then group. So when we see this, the sections that are talking about things like mean, resolution, and shall, we think that's legal talk. When it's talking about default, event, trustee, we think that's risk talk. And we want to see, is the complexity within these sections more informative about the yield spread over our sample here. And we'll do this for subsets of our rating bins. So again, a lot going on here. I just really want to point out the biggest effect here. Again, these are the coefficients on the complexity within those different parts of the statement. The legal complexity is the most important. So across from the high grade bins all the way down to the unrated, legal is driving this complexity yield premium, but it gets bigger and bigger when we're in those low and unrated sections, whereas the others become most important in low grade and unrated, but their magnitudes are going to be much smaller. So in conclusion, there's a cost to complexity in the municipal bond space. We think it's largely because we have a large presence of ultimate investors being retail investors. If there's more institutions, it's not such a problem. Despite of that, kind of puzzlingly, we see a stark increase in complexity. We think it's because an increased regulatory oversight, and there's also some evidence of that catering hypothesis. Thank you very much. Wynn, I look forward to your comments.
So for those of you who have been coming to this conference for a while, you're all familiar with the inimitable Wynn Smith from Wells Fargo. Wynn, please. Thanks.
Hi, good morning. I'm Wynn Smith. I'm with Wells Fargo in the AI innovation team, but I have 30 years of bond market experience. Before I start, I do have to stress that these are my thoughts and not those of Wells Fargo. Thanks very much for that interesting presentation, Mark. And I'm really glad these two papers came together this morning, because the de minimis talk and these real examples from Detroit really set up an important issue with this kind of analysis, which is the dependent variable here is a yield spread or a complexity yield premium. And the calculation here is done comparing expected cash flows on a municipal bond to maturity to Treasury cash flows or Treasury bonds to maturity. So as I understand it, what we got here really is a bond muni bond yield to maturity versus a treasury yield to maturity. A hard look at the call option and make sure that you're taking that into account and not just assuming that the cash flows and maturity are the most relevant thing here. And I think that that yield spread also was involved in a couple of the papers yesterday. So I think anyone who's doing this kind of regression analysis in the municipal bond market, you've got to be real careful. I think there's a corporate bond approach that's been adapted to municipal bonds, but that call option is so important. It's not just a flag that should go into the regression analysis. It completely changes the character of the bond. So it's really crucial to take into account the call option. And that's, that may change the character of some of the results. So, I hope that you do that. And then, of course, was something that Andy Collatay talked about at length yesterday with great passion, as he always does. And it really is important. It's something that creates all these weird, distorting things in this market. And so I just urge all researchers to be very careful about that. But I do want to make some. This is a really great paper. This analysis of the complexity. I like the topic analysis, and it's really very plausible that complexity makes costs higher for the retail investors, and the retail investors are really important. There's more and more of these separately managed accounts. There are a lot of fairly sophisticated retail investors, but when you have all this, often there's just redundant, difficult information. That example you had up there, I didn't do slides because I would have to go through 5 layers of approval at Wells Fargo. But if I could do a slide, if you remember the first Willy Wonka movie, and the kids come into the factory, and they have to sign this contract. Does anybody remember that contract? It starts up here, and it gets in smaller and smaller print, and this kind of goes off to infinity. And it's pretty much like a bond. And that looked just like that. And it's great. And that's what a lot of legal disclosure looks like. But you worked on complexity, you use these measures of complexity, some about readability. I just want to point out that where's Rich? There's Rich. Rich hosted a really interesting discussion at lunch yesterday about disclosure quality, and I learned a lot from all these different perspectives. And there's a lot to disclosure quality. It's a complex topic, but complexity itself is just one of the issues. So you kind of have an axis between simple and complex, but it's not the only axis. And there's an example in your paper that got a fairly good score because the sentence is well short, but it basically said, this account is blah, 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 blah. This other account is blah, 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 blah. It was kind of a run-on paragraph. And it wasn't really that easy to read. And it wasn't really that easy to say, well, why is this here and what does this matter? And if you spend enough time on it, you say, well, these 3 accounts really actually are true assets, and these other accounts are things that the issuer manages for somebody else. But you've got to spend a lot of time to break that out. Even though it's short sentences and it's not that complex in one way, it's really not very clear. So I think there's an axis between, clear and unclear, and it's not quite the same thing as between simple and complex. So, and then there's, is it standardized or not? We had a great conversation about, well, can everything get standardized, or is it practical, or how do you define what the standards are? There's so much to think about with all of that. But there are some new approaches to looking at clarity with neural networks. There's a paper I'll share with you. I don't know if you can use that or not, but that would be something to take a look at. The last thing I'd really like to mention is, I guess I'll say that pirates didn't cause global warming. I don't know if you've seen this, but there's a nice chart that says that the number of pirates going down over time. is correlated very well with global warming. So, yeah, these are two things that happened at the same time. So there's an association, and you were careful to say association. But it's important, I think, to be careful that we maybe don't oversell. Where is the causation? I mean, it does seem really clear that between retail and institutional, there's real complexity effect. But, you know, you do a lot of analysis across a lot of dimensions. And, you know, are there times when something is just an inherently difficult bond issue, and it's going to need a lot of disclosure, but it's inherently just risky? And so that complexity is not really causing, the complexity of the disclosure isn't really causing the pricing. It's just two things that are coming out of the same, like, you know, ice cream shit sales and shark attacks or whatever. Probably one's not causing the other. Although I'd probably want some ice cream if I was, you know, scared by a shark. But so, and then, you know, if you've got a nice school district, whether it's 100 pages or 200 pages, you know, and whether you get the biographies of all the board members, I don't know if that really is going to affect the pricing very much. So, but I think that everybody's got to be really careful about the call option in the muni world, and just taking the comparable maturity treasury. You know, a 30-year muni isn't really a 30-year muni most of the time. It's really much more likely to be a 10-year. And so to compare that against a 30 is, you know, could very possibly distort your results. So again, I really appreciate the paper, and thanks very much.
Thanks, guys. I guess one of the questions that I have is, or one of the observations, I guess, that I have is that remembering that these documents are the bond indenture. It is the security, and the institutional market wants to see all the fine print and all the details, and they actually read through them, and the more disclosure you have. So the idea that, and when you brought up causality, the idea that that complex sentences and complex words are somehow associated with higher yields or higher spread seems to me to be that it's just the reverse. Something that is a lower quality security is going to require more disclosure, more explanation, and it gets complicated in the document itself. And so I would just say, I guess echo Wynn's comments that be careful with causality versus correlation. But Marcus, why don't you take a few minutes to respond?
Yeah, thank you both for those comments. I'll just one thought about that. We do a lot to try to control for, you know, the observable things that you can see being different between the different types of bonds. You know, the size of the bonds, the maturity, and callability. Ultimately, it's difficult to distinguish the communication of the complexity versus the complexity of the actual bond. And we've been working on more ways to look into why that might be driving the results. I think that's why the clientele results are so interesting, is because we see a lot of the dynamics coming from that retail space versus institution with plausible exogeneity and how we define those clientele effects. One thing I didn't get to show, and you mentioned it might be the reverse in terms of the complexity benefiting. In the secondary market, and there's, you know, all the caveats with how much trading is happening, but we see markups are actually smaller when it's an institutional trade for more complex bonds. Now, it's higher for retailers, but it's actually smaller for those institutions where you can kind of see a clean cut of they're likely the ones trading here, which is consistent with what you were saying. So, and then Wynn, awesome comments. We really thank you for all that time. He warned us about him bringing up the call option
spread in terms of instead of the yield spread. So we looked at, and it's a very small subsample of non-callable bonds, and things are qualitatively similar there, and you still see that big increase in complexity. So that was reassuring, but I think we do need to do it at a full sample and do it more thoroughly. So thank you for that. I'm definitely stealing your Willy Wonka reference for my slides next time. And that clarity versus complexity, that paper, that sounds like a good breakthrough for us. So please share that.
Okay, questions, Lori?
Let me bring you a mic.
Oh, sorry.
Oh, thank you. I think that there's a huge difference depending on the bond as to who's reading, if anyone, the disclosure statement. And that's what you were getting at with the retail and institutional. But I think it's relevant who's writing. So in those official statements, you have the names of the law firms, you have the names of the underwriter, you have the names of the underwriters council. I think it's funny because I'm always telling my clientele, public agencies, don't worry about the who, look at the what. But here I'm going to say, look at the who, because people do have styles and approaches. And then I would also think that, and by the way, I love your paper and I love the concept of it. And I would also look at whether it was a competitive or negotiated sale. And that is something that I don't hear that in any of the papers here, but it is relevant to every bit of research because the process for bringing a bond to market in a competitive sale and a negotiated sale is very different. And then I'll just say I've had dozens of expert witness cases in which it appeared to me that I was the only person who read the official statement. And so people are being deposed, right, going back, did you read the official statement? And they're like, yes. And they're like, do you have any correspondence on it? Did you ask any questions? Is there any evidence whatsoever that you read this? And they didn't, but they're testifying that they did. And then when we show them what apparently they weren't aware of, the case kind of ends, right? And then the other thing is you said something about the SEC. And my observation is there's very little prosecution of a failure to disclose, even though they may have increased the cases in terms of how many bonds there are. And yet in a litigation, that disclosure document is absolutely key at almost every single point of a claim, going to what that official statement said. So you're talking about lawyers reacting to litigation or prosecution, and I think you should actually interview, the ones that you're seeing in the high complex and the low complex, some of those counsels that wrote it, and ask them what influences them, because what you might find is you have some proxy factors, in your regression, and if you actually ask them what's motivating, you'll find some interesting things, because I don't find that lessons of litigation actually make it anywhere. And the reason is because so few bonds default. So people will say we're doing this to avoid this kind of problem. And when I'm on the beginning, I say, has that problem ever occurred that you know of? And people, they just don't. They have a point of view and a bias and whatever. So I encourage you to get more into the people and how they're making decisions. And then I will just say, over time, I've seen these things get so complex that nobody reads them. And there's one more thing. I have no idea if you can test this, but you're doing this stuff with language. The lawyer writing and the financial information coming from somebody else can produce not good disclosure or excellent disclosure, depending on that process. So I don't know how you would explore that, but I'll just give you a simple example. Very often what I do in an expert witness case is I take the numbers that are in the official statement and I just extend them further in time, or I do one small change to them and I show that the bonds defaulted exactly as predicted in the official statement if the numbers had been extended. Does that make sense? So it's like a simple thing. Why is this only being shown for 5 years when it could be shown for 10? Right? Why are these 7 factors shown and not totaled? It's things like that that make the difference. So there's a numbers language issue, and I'm not articulating it very well, but if you want to talk to me after, I'll give you some more examples.
Oh, that would be great. Yeah. That was more questions that I can respond to even in that one. So I'll try my best. That was awesome, Lori. I'd love to talk to you more about it. So in terms of
who is writing it, I agree that's a very important thing. We did look at competitive versus negotiated issues, and we see that it was primarily strongest in the negotiated. And there's various reasons for that, which is what we need to untie. Is it because retailers can participate, or is it because it's mostly written by the underwriter? But we need to collect that data. We need to collect the number of bond counsel, the number, because these things have all expanded throughout time. And I think once we have that data, we can answer more questions about who is writing it, how important are they within that. But and I agree, we need to do. This is our first step in more interaction with practitioners, but we need to interview some people to get to the bottom of it. But
I think I want to keep moving. We only got a minute left here, but Laurie, thank you so much for those comments. Always appreciated. I just want to keep things on schedule here, so I'm sorry for the audience, but let's thank you, Marcus. Thank you, Wayne. Okay, our last paper for this session, Financing Infrastructure with Inattentive Investors, the case for U.S. municipal governments. Ehsan Azamza from the University of Illinois in Chicago, and Financing Infrastructure with Inattentive Investors. You better pay attention.
Hello, everyone. Oh, I need to speak to you. Hello, everyone. It's great to be here, and it's a great pleasure to present my work and get your feedback on it. So I should say that it's my only municipal bond-related paper, so I really need your feedback on this. Okay, so definitely, as everybody knows in this room, municipal governments are responsible for providing infrastructure stuff like schools, hospitals, roads, bridges, and they finance these projects by borrowing in the municipal bond market. So municipal bond market is the primary source of financing for these important projects. And because of that, the functioning of this market, this municipal bond market, is very important for us. So that's the topic of this paper. There are some puzzling observations in the market. On one hand, we see that the bonds are quite safe in terms of their probability of default, so the empirical rate of default has been quite low, so they are safe and they should be very attractive for investors. That's one thing. The other thing is that in the academic literature, we have several evidence suggesting that these governments are facing difficulties in raising their debt, so they have difficulties in getting the financing for investing in these projects, so it's kind of a puzzle for us. So potentially there are several reasons that are contributing to this puzzle. It could be related to taxes. Some papers have shown that. So it could be about a regulation to some extent. But here I want to talk about the role of investor composition. So it's something that actually Marcus talked a lot during the previous presentation, that the investor composition in the market is very unique. It's something that you can see in this figure. So more than 40% of the municipal bonds are being held directly by the household sector. This number for corporates and treasuries are 7% and 6% respectively. So in terms of investor composition, things are very different compared to other markets. And the point that I want to make during this presentation, this investor composition matters for the ability to raise financing, and actually it can make it difficult for governments to raise financing, at least in a timely manner. Okay, so households are being known to be a buy and hold investors. They don't necessarily pay attention to the market developments or new bond issues, and because of that, I argue that the borrowing ability of these governments are limited to the capital available to mutual funds and institutional investors. So that's the thing that I test in the data, and also I have a model to kind of illustrate the mechanism, and I do some calibration. Okay, so to illustrate this point, this figure is helpful. So this figure shows the ownership of municipal bonds by the mutual fund sector by quarters after issuance. So what we see is that mutual funds, as the specialized intermediaries in this market, they disproportionately hold newly issued bonds and gradually resell those bonds to the rest of the market. And this transition takes more than 10 years. This figure is very robust. So you can see many versions of this paper in the appendix version, in the appendix section of my paper, which is posted on the web page. It is robust with respect to the choice of a state, credit rating, time to maturity, whatever. And what we learn from this figure is that mutual funds are acting as some form of market maker, that when there is a new issuance, they disproportionately buy the new issue and gradually resell to the rest of the market. And because of this, capital available to these mutual funds is very important for the borrowing ability of these governments. So that's the thing that I test and verifying data, and also I have a model for that. Okay, so as I said, I have a model to make sense of what's going on. So technically, in any market, in any financial market, we can think of things as something in this figure that the ultimate holders of all of these assets, municipal bond or anything else, are households. So the thing that is different in the municipal bond market is the fraction of the direct holding versus indirect holding. And the problem is that the households are quite slow, or maybe they don't have enough time. So Marcus actually had a very good slide for that, that maybe they don't have the time to actually analyze the assets and the cash flows. And because of that, institutional investors are actually helpful to facilitate the transactions. And the point that, so the implication of this is that capital available to institutional investors like mutual funds is important. So basically what I test specifically in the empirical section is that the capital flows in and out of mutual funds impact the borrowing ability of these governments. Also, I have results about the cost of borrowing, but I show that the impact is basically larger for the size of the borrowing. And I have a model to illustrate the mechanism. Also, I calibrate the parameters based on my empirical estimates, because eventually what we learn from this study is that how easy it is, quantify it, that how easy it is to raise debt in a timely manner. So I look at the short-term and long-term demand elasticity that is helpful for us to understand how easy it is for governments to raise their debt in a short period of time, like the thing that we needed during a pandemic, that you need to access to liquidity in a short period of time. And it's important how easy it is to do that. Okay. So first I talked about the empirical part. The data I used two main data sources. One is Bloomberg, from which I obtained the historical bond issuance data of 262 county governments. I focus on county governments, not state governments or state level government units, because states are very different in terms of regulation and taxes. So you want to somehow control that, or you want to insulate yourself from those differences. And because of that, I mostly compare counties within a state in my analysis. So that's basically the nature of analysis. And counties are good because they're the largest sub-state government units. I mostly focus on the largest county governments and the ones that are issuing bonds frequently. And the other source is CREST, from which I obtained the historical holding data of mutual funds. And because of that, I can see which mutual funds are important for a certain county government. And some summary statistics. So these county governments issue $82.3 million in every quarter that they have issuance. And they have issuance roughly in 1 out of 4 quarters. Regarding the mutual funds, in my sample, so their market share has almost doubled over the past 10 years. And that's another reason to understand what's the role in the market. And one important thing about the mutual funds is that they have very little cash buffer. So when they receive withdrawal requests, they need to respond by selling some of their assets. And because of that, capital available for them becomes important. So that's the thing that I verify. So they cannot respond to withdrawal requests by just basically using their cash, because they don't have any cash, or they have little cash. Okay. Another thing is that these mutual funds hold very diversified portfolios. There is no mutual fund that only specializes in county governments, so they hold very diverse portfolios in the states at which they are active. And you see that the average exposure to county governments is about 5.9%, and in the 90th percentile is 11.7%. And the maximum exposure to a single county the 90th percentile exposure to a single county government is about 2%. So there is almost no mutual fund that specializes in a single county government. So that's something that becomes important in the identification. Okay. So what do we want to do? So regarding the strategy, okay, so first the hypothesis, as I said, was that we want to understand how these capital flows in and out of mutual funds impact the borrowing ability of these governments. And the problem is basically endogeneity of these flows in order to establish a causality. So flows basically change with the taxes, the economic condition. So the trick here is to basically exploit the heterogeneities across country governments in their exposure to mutual funds. I talk about that and I clarify that in the next slide, but it's a very, very standard strategy in the empirical asset pricing literature. Okay, so in my data, I have a bunch of country governments, bunch of funds, and these funds, some of them are more, some of these country governments are more exposed to some funds, less exposed to the others. For example, Fund 1 is an important fund for country 1, but Fund 2 is less important. So suppose Fund 1 receives a large outflow, it means that it needs to sell some of these assets, especially country 1 gets affected, country 2 gets affected less. And because of that, country 1 faces more problem in raising new capital from Fund 1 or overall. And because of that, we want to see how country 1 responds to this outflow, how this outflow impact country 1 compared to country 2. So basically, we are going to compare country 1 to country 2. But overall, in the data, definitely all funds receive some sort of inflow or outflow. So what I look at is the aggregate impact on the demand for the bond. So basically, I construct this measure of flow-induced demand by aggregating the impact, and I look at how countries with a high flow-induced demand behave differently compared to countries with a low flow-induced demand. So that's the empirical strategy. And because of this, I'm isolating the impact of taxes, economic conditions. So because I'm just comparing these country governments based on their exposure to mutual funds. Okay. So the assumption here is that the cross-section of the flows is uncorrelated with the government funding need. What does it mean? It means that if I'm investing in Fund 1, I'm not doing that because Fund 1 is a little bit more exposed to country 1 rather than country 2. And that's basically okay because, so as I said, mutual funds hold very diverse portfolios, and because of that, so basically their exposure to country governments is very small to basically make to make investors to invest in a certain fund. Okay, so now we get to the result. So what I find is a 1% increase in the flow-induced demand increases the size of issuance in the next quarter by 0.2%, and this result is robust with respect to different, basically a specification, different set of controls after controlling for the economic condition or the financial situation of the countries. Even with considering the taxes, I have a whole section about the role of taxes in the results, and this result is quite robust. And also look at the long-term impact. So the long-term impact is a bit smaller. So 1% increase in the flow-induced demand increases the size of issuance in the fourth quarter by 0.1%. So the short-term impact is about 2 times larger than the long-term impact. So short-term impact is quite large, and it's something that is important in my calibration. Regarding the cost of issuance, it impacts the cost of issuance, but the thing is that the size is way smaller. So 1% increase in the flow-induced demand decreases the cost of borrowing by 0.2 basis points. So the impact is about 100 times less than the impact on the size of borrowing. So what we learn from these observations is that when country governments receive basically demand from the mutual fund sector, they mostly respond in the quantity dimension rather than the price dimension. So basically, their supply of bonds is quite elastic, and it makes sense. So when they are ready to issue new bonds, so they're mostly adjusting in the quantity dimension rather than the price dimension. Okay. So now I talk about the model, and in the model we have a representative municipal government that sells the bonds, and the bonds are risky, and I match the product of default with the empirical the empirical default rate. And on the demand side, we have some investors directly investing and some investors indirectly investing in the mini bonds. and if mutual funds are taking the money of the indirect investors and investing in the mini governments, the key element of the model is that these investors are slow in their rebalancing. So they rebalance. So basically their speed of rebalancing is captured by 1 minus lambda. When lambda is higher, it means that they are slower in their rebalancings, and basically, but mutual funds are different, so they are active. So I also estimate the demand for the mutual fund sector. So I basically use the empirical estimates to calibrate this model. What I find is that the elasticity of supply is quite high. So to basically match this observation that most of the response is in the quantity dimension rather than the price dimension. The long-term demand elasticity is also high. So there is no problem in the market in terms of the long-term demand. But most of the problem is in the short-term demand. The short-term demand elasticity is quite low. It means that the market is quite slow in responding to new bond issues. And because of that, the evidence suggests that, the empirical evidence suggests that governments have difficulty in raising debt, expanding their debt quickly. And that's especially important in times of like a pandemic or the time that actually they need to access liquidity. And to conclude, so I started this puzzle that governments are behaving as if that they are credit constrained while they are issuing bonds that should be very attractive to investors. So the explanation, so there are several factors that basically contribute to this. So I argue that partly is because of the fact that, because of the investor composition, the fact that the market is dominated by retail investors. And the implication is that capital available to mutual funds and institutional investors is important for the borrowing ability of these governments. And it's something that is consistent with data, and also I develop a model to illustrate the mechanism. And the policy implication is that the mini market is not resilient against shocks. So at a time of pandemic or at a time of crisis, maybe the government need to provide some assistance with access to liquidity because of this. The problem from the investor composition is very difficult for governments to expand their debt quickly. And in fact, in my model and with the calibration, I can provide some rough estimates that how much assistance should be provided based on the amount of capital outflow that the mutual fund sector experiences. Thank you very much.
So the discussant, Kent Haichu from E&Y, Federal Reserve, U.S. Treasury, and the list goes on and on.
Thanks very much. How do I make this? Okay. It's the hardest part of the presentation. This is my first opportunity to be a discussant, and I think this paper really epitomizes what this conference is all about. I had a 30-year career as a public finance investment banker, and I'm totally intimidated by economists like Hassan and his expert statistics, regression analysis, econometrics, and so forth. So I'm not going to attempt to pierce those issues or try to understand those issues. I'm going to give you, and I've given Hassan, a perspective from what I observed over the course of my career. And that's the approach I'm going to take to this presentation. The summary of the findings, as I read the paper, trying to turn it into English, is that tax-exempt securities are primarily attractive to individual retail investors who are, quote-unquote, inattentive. Therefore, attentive mutual funds are the conduits for retail to initially purchase new issues before redistributing them over time, as Hassan's first chart demonstrates, and in fact it ties in very well with the first paper that I participated in this panel. In periods of reduced retail demand and/or mutual outflows, the cost and availability of capital for infrastructure is impeded. The conclusion to that is that this retail dynamic that we all know about in the municipal market is a primary reason for the poor state of U.S. public infrastructure. And finally, in terms of the policy recommendations, Hassan suggests that the Federal Reserve should intervene during periods of mutual fund outflows to support state and local infrastructure investment. So overall, this is a great paper because it demonstrates what we all know in the municipal bond market and what we practice every day is that our market is heavily dependent on retail investors, whether it's direct or indirect, because of the tax exemption that is available through the tax code. I think my issues really surround the use of inattentive and attentive, which is why I've quoted them, because I think it is kind of a pejorative term that doesn't really appreciate what's going on underneath and why these kinds of behaviors occur. And then lastly, I want to talk about the conclusions that Hassan draws from this dynamic that we all appreciate. So why are retail investors considered inattentive? There's a number of reasons. First of all, when we're talking about selling retail bonds, the sales commission that is available that motivates broker-dealers to sell these in the primary market is very low. So it's $50 if you sell someone $10,000 of bonds. And so we always had a favorite expression that Wynn can appreciate when we have a pricing wire that goes out and it explains each maturity, as Kevin was showing, what the price is, what the yield is, and then over here, I'm sorry, and then over here on the right is the sales commission. And we always used to joke that the retail and broker-dealers, they don't read right to left, they read left to right, right? So if they see a sales commission for $5, they're probably not going to call their retail customer. And instead, they're probably going to sell them a bond in the secondary market at a much bigger spread. Or they may sell them another entirely different asset class that has much bigger spreads. Number two, the municipal market, as we know, is really 50 separate markets. Individual retail usually buy retail bonds in their own state. And so the timing and size of retail demand isn't clearly, in most instances, not going to correspond to when an issuer is coming to market. And then the third point is, I think people don't appreciate the mismatch between the availability of capital from retail and the need for capital by issuers. Issuers finance long-term assets, capital improvements, over a 20 to 30-year horizon. Retail investors have no interest, the typical ones, in investing for 20 or 30 years. And so the concentration of retail demand is at the front end of the curve, not at the long end of the curve. And of course, most of our debt is sold as level debt service with ascending principal. So the principal is backloaded and the retail demand is at the front end. And so there's a mismatch between, even though our market's dominated by retail, there's a mismatch between the individual retail investor and what the issuer wants. Let's turn to the mutual fund side, the attentive mutual funds. Well, why do the mutual funds, why are they such big players in the primary market? Well, when you go to market and you need $10 million to build your new school, you can't just say, I'll take $5 million and be done with it. You need to price the entire issue at a clearing price. And so you need institutions to support individual retail so that the entire bond transaction can get done on the same day, same time, and at the same interest rate. The issue about mismatch is solved by mutual funds. Mutual funds effectively create synthetic demand for longer-term maturities because they take in retail investments which are available at the NAV at any time to get out, to redeem, and they're able to look for yield and buy at the long end. So essentially, institutional investors, and in particular mutual funds, are critical to resolving this mismatch between retail and the needs of issuers. If we didn't rely so much on retail, the natural buyers would be pension funds and insurance companies who would otherwise not benefit from tax exemptions, so they're largely absent from our market. But I will say that there are also times when there's less retail demand, when traditionally we have what are called crossover buyers that come in who are not natural tax-exempt buyers, but they see the inefficiency in the muni subsidy, the tax benefit, and they come in and they buy the bonds, and the market is then strengthened, and the value of the tax exemption goes back up, and mutual funds come back in. So that's inattentive investors versus attentive ones. The conclusion that absence of retail demand inhibits state and local infrastructure investment, I think, is largely true, but I would like to distinguish between the cost of capital versus the availability of capital. And generally, because of these market forces, my experience is that issuers don't largely time their issues to when there's a lot of demand, when there's a lot of supply. They generally have a long schedule of governmental approvals and creating very complex disclosure documents that when they're ready to go, they have contracts that have been signed, and for new money issues, they come to market. I think it's more likely that this timing issue is directly affecting refundings more than new money, and I'll talk about that in some data suggestions. So I wonder, and again, not able to comment on Hassan's incredible regression analysis work, if it's actually true, because my experience is that it's not, that retail demand actually impacts the availability of capital. It certainly impacts the cost of capital. What I think the paper doesn't explore is the state and local debt capacity limitations on infrastructure investment. And I think that's the strongest factor, two factors being the affordability, the ability to afford debt service, and the political support necessary to raise revenues, whether they're taxes, fees, fares, utility rates, whatever, that are necessary to support investment in infrastructure capital. Just two examples here in terms of the inflows and outflows of mutual funds. So obviously in March of 2020 through April of 2020, just in like a 6-week period, we had about $45 billion, an unprecedented outflows into out of mutual funds as retail rushed to get out of the market as the pandemic took hold and all the markets were put into a crisis. It's interesting, though, that with the beginning of the Fed tightening policy, we've had 3 times as much outflows as during that period during the pandemic, but outside the municipal market, no one's really aware of that or talking about it because it's occurred over a 12 to 18 month period. And certainly during March and April, for a whole lot of reasons, we had illiquidity, we had no issuance. But I don't believe that issuance has suffered particularly, other than refundings, during the last year. And then lastly, I've always been an advocate of trying to deal with this retail issue by expanding the market into taxables. Quickly, just suggestions for Hassan's paper. I think he may not be capturing a very important element of demand, which is principal reinvestment in the mutual fund. So as municipalities either pay off their debt, whether through scheduled amortizations or redemptions, they reinvest that into the marketplace. I don't know if that was picked up in the data. The increasing importance of SMAs, several people have mentioned. There was a headline by Bloomberg yesterday that SMAs now account for 25% of the municipal market demand. Again, I'm not sure that that was picked up. I've already mentioned, I think it would be very interesting to do the analysis separating out new money deals from refundings. And I would also be interested in seeing the same analysis if we focused on large repeat issuers, regardless of whether they're a county, a state, or a revenue bond, because I think their behavior may be different than what Hassan found with 262 counties. Lastly, I have to comment on the policy recommendations. Being at the Fed when I learned a lot about the Federal Reserve's authority, its legal authority, and Section 13.3 dictates when the Fed can intervene in unusual and exigent circumstances. It takes a vote of 5 of the 7 Reserve Board members, the governors, plus the approval of the Treasury Secretary in order to intervene. The statute says there has to be an inability to secure adequate credit accommodations. It's reserved for providing liquidity to the financial system. It's effectively a backup, not a first lender. And there has to be, the interest rate has to be set at a penalty to encourage repayment of the loan as quickly as possible once normal market conditions are restored. A lot of people didn't like the interest rates for the municipal liquidity facility, but that's where it comes from. And I question, having been through this once, how likely it would be for the Fed to intervene only in the municipal market as opposed to all markets. I think the reason the Fed intervened in the COVID for the first time in its 100-year history in the municipal market was because all the markets were in disarray, including the municipal market. Even if the statute provided the opportunity for the federal government to intervene, I think there are serious policy questions around moral hazard, as we talked about on some of the panels yesterday. And then finally, my favorite sort of policy issue that, or the issue that policymakers, I think, confuse all the time is the difference between funding and financing. I think we have plenty of capital in this country, but we don't have, we have plenty of financing and capital in this country, but we don't have funding capacity, meaning the revenues to support investment in infrastructure. So with that, I appreciate Hassan's paper and the opportunity to discuss it with you today.
David, we're running right up against 11:15. Should we pass on Q&A? Okay, good. So Hassan, why don't you briefly respond, and if we have a minute for a question, we'll take it there.
Sure. So, this one. Okay, perfect. Okay. So first of all, thank you very much for the comments. So I really couldn't ask for better because, as I said, so it's my first municipal bond market related project. So, and I learned a lot from your comments, and definitely I took them, I incorporate them in the next version. And I'm also very glad that you agree with the main point that so there is this problem with the investor composition. We should take it more seriously, and it could affect the access to capital. So and also I agree with your suggestion that we should basically expand the taxable portion. I really agree with that, and that helps with the financing. And regarding a few points, so yeah, I need to look at the new money versus the refinancing. So that's important thing, because eventually what we want to understand is that whether governments have difficulty in funding new projects rather than just refinancing the older debt. And regarding the timing, so there is something that I couldn't show during the presentation, that this demand from the mutual fund sector cannot predict the timing of the issuance. It can only, so So basically, once the government enters the market, so condition on issuance and being ready to issue, that's the thing that demand actually gets affected by the demand. So condition on issuance, demand impacts the size of issuance. So that's basically what I find, which is kind of consistent with the fact that it's very difficult to, and there's a long process of getting to the market. And yeah, so you raise a lot of several points that I need to basically take into account in my empirical analysis.
I think we have time for a question or two. Yes, Mark.
Thanks. The underlying problem seems to be the tax exemption, because that creates a much more narrow market and a much more illiquid and maybe reactive market. So I'm wondering if, building on something in one of Ken's slide, how do you feel about the following solution, which is that we permanently replace the tax exemption on municipal bonds with a subsidy to the issuer. So basically make the Build America bond permanent and use that as a replacement for what we currently have.
So I see my friend smiling in the back on that question. I think that would be a very difficult politically, and I think from a policy point of view, there's problems with it, because the history of the BABS program is that Congress began to cut back the subsidy, and that has left an incredibly sour taste on the issuer side, and I think it creates policy uncertainty going forward. But I am a big advocate of BABS as a market regulator, so that if there was the right subsidy level and that was always available in the marketplace, first of all, you could develop a consistent demand from the taxable sector. The taxable sector never invested the time and resources necessary to be true muni investors, because BABS only lasted a year and a half. But if it was permanent, you could build that capacity, and then when the tax exemption got too cheap, and this was going on the yield curve when we sold BABS. We only sold BABS on the long end. We used traditional tax exempts on the short end, and we created a blended structure that was the most efficient. And having that BABS as a market regulator together with tax exemption would bring in new investors while keeping the benefits of the retail.
Mark, you had a question? And I think that's it. We'll wrap it up. Go ahead, Mark.
It's just a comment. I am so glad that Kent mentioned the politics. You know, issuing bonds generally requires voter approval and frequently requires a supermajority. That is a major constraint.
Hassan, Kent, thank you very much.
Thanks, Mayor.
Great. Thank you all. We're going to take a break. We'll be back here in 13 minutes at 10:30 for our next panel. Appreciate it. We like to stay on schedule. Gottbaum. If I can get everybody to come in and sit down so we can resume. And I really appreciate Yafa is coming to be the moderator in the next session. And I'm counting on her to do the same job that Steve did in keeping the speakers to the allotted time.
Good morning, everybody. My name is Yafa Ratner. I'm a Senior Managing Director at Hilltop Securities and also their Head of Credit. I have a confession to make to everybody in the room. This is my first time here, so I was taking active, copious notes watching Steve moderate the panels and keep everybody on track. I hope to be able to be similarly successful. To me, as the first time here, it's really amazing to watch the intersection of academia and what we're seeing in the muni markets on a day-to-day basis. So I'm super excited to really think through and with each of our three panelists and discussants today. So first on our agenda is Mark Joffe from the Cato Institute. He's going to be discussing his paper on financial reporting standards for U.S. state and local governments. Mark?
Well, I have good news for you, for those of you who are practitioners and don't like equations. My license to Stata from graduate school expired, so I was not able to do any regressions as part of this paper. So I want to talk to you about the need for better financial data standards in the municipal bond market. I wanted to paint for you a picture of what I think the ideal outcome should be, not only for researchers, but anyone who is in an oversight capacity, be it in a state, be it a federal grantor, and of course, if you're in the municipal bond market as an investor. What kind of data and how it should be presented should we expect? And I think what I outline here is really a minimum realistic expectation. I don't think it would be very expensive to implement given all the modern technology that exists today. And I think it's more a matter of how we should get here as opposed to whether. So the first box at the top gives you sort of the idea of an ACFR database. So you'd imagine one row per entity per year. It would have columns for different kinds of assets, current and fixed, liabilities, especially other post-employment benefits, which we learned yesterday are very difficult to collect, and I can attest to that fact. Taxes, user fees under revenues, and then obviously expenditures by category. So you can imagine a spreadsheet with maybe 30,000 to 40,000 issuers, those who produce audited financial statements, one row per year, perhaps 300 to 500 columns of information. You know, this is something that is well within our capacity as an advanced economy to produce, and it's sort of really baffling as to why we haven't been able to get here yet. I think it's also important to note that we can get some of this data, but it's on a often very delayed basis. So the idea here should be it should all be audited information, and it should be information that's available shortly after the fiscal year end for each entity. And then I have a second table coming out, and then this is for official statement information. So things like the coupon rate, the maturity date, what kind of callability provisions there are, issuance costs, and other terms and conditions. So for those in the institutional market, I know you get this, but you might be paying a vendor, $30,000, $40,000, $50,000 a year to get it. This really is a public good, and everybody should know about it. So this further evidence that this is not impossible comes from many states. So if we look at the bottom, that's already served up in Texas by the Texas Bond Review Board. So you can go to the Texas Bond Review Board's website and download this kind of data set for free, and it's updated on a fairly regular basis. The ACFR portion, Washington State, New York, less competently, unfortunately, my state of California, Ohio, Utah. There are a number of states that, again, have already accomplished this at the state level, and there are many states that haven't. So the idea is, with things like the Financial Data Transparency Act, that hopefully we can nationalize this and achieve this for all states. So what are some barriers to getting this kind of information on a regular, predictable, and comprehensive basis? So I've listed them all here. I'm going to just take you through them one at a time. So a real thing that holds back our market is CUSIPs, okay? The global CUSIP services actively and aggressively enforces intellectual property and monopoly control over CUSIP identifiers. And that really damages the redistributability of information. So, for example, if I go to MSRB's EMMA website, I can't copy and paste a security identifier because it's been protected. I can't download a large amount of information. In fact, I can't even download their collection of annual comprehensive financial reports because I, as a think tank researcher, do not have a CUSIP license. So, you think about the equity market, there are like a 3 or 4 position identifier for stocks, and it's in the public domain. Everyone uses it. It's freely exchangeable. I can go to 12 different websites, type in the AAPL, and see all the information I want about Apple. Why shouldn't I be able to do that about, say, the city of Cleveland, for example, right? Where my discussant mentioned at a recent SEC meeting that when he goes to EMMA to look for the city of Cleveland, there's about 10 city of Clevelands there because there's a lack of a unique identifier. So, CUSIP should either be reformed or replaced. So one opportunity for reform is the current litigation by Dinosaur Financial Group and Hildene. Those are 2 separate cases that have been merged. There was a recent court order relating to that case. Some of the aspects of the complaint have been dropped. Others are being retained. One finding is that neither side contested the fact that individual CUSIP numbers are not copyrighted. So I think that does severe damage to the claim that this is intellectual property. Now, Global CUSIP Services, part of FactSet, is insisting that it's the collection of all of the CUSIP numbers and the reference information that represents their intellectual property. But again, that's really trivial information and should be freely redistributable. So, barring an improvement to CUSIPs, we can look at replacing them. And one thing that's contemplated in the Financial Data Transparency Act is extending the system of legal entity identifiers. It's now common in the private markets to government bond issuers. Also, we can look at replacing the CUSIP as a security identifier with the Financial Instrument Global Identifiers, or FIGIs. So that is basically a big portion of Bloomberg's reference data set that's been made public and is available at openfigi.com. So you can see hundreds of thousands, or over 1 million, I believe, municipal securities there. And if that was integrated into EMMA instead of CUSIP or in addition to CUSIP, perhaps we could have a more free flow of data. A serious problem that we have in terms of reaching the vision of full and timely information is late filing. So in the municipal market, we normally allow 6 to 9 months for financial statements to be reported, which contrasts pretty severely with the corporate market, where it's 60 to 90 days for public companies. But even that 6 to 9 month time frame, a lot of issuers or a lot of government entities, because I don't want to differentiate necessarily just between securities issuers and those that have to file financial statements because they fall under the federal single audit or because they have a state filing requirement. So many governments can't even make this 6 to 9 month limitation. And some of those are very important. So if we look at the last 2 cities that have filed for bankruptcy since the year 2020, Fairfield, Alabama, and Chester, Pennsylvania, both of those were over 2 years late with their ACFRs, right? The Commonwealth of Puerto Rico, another huge case of bankruptcy, was at least 3 years behind on their ACFRs at one point. Now, an entity that I don't think really has any credit worries at the moment, the state of California, still hasn't been able to get it together for the last 5 consecutive fiscal years. And in the last fiscal year, where they reported 2021, they were a full year late. So California's ACFR was provided 21 months after the end of the fiscal year. Compton, California, missed some years entirely. There is no 2015, 2016, or 2017 Compton ACFR. Mount Vernon, New York, the last time I looked, and I apologize, I haven't updated myself just before this meeting, is at least 5 years behind. I think the last one I saw was 2016. So, this is not something that taxpayers, municipal bond investors, regulators should really accept. And I think there are a couple of solutions for this. And the key solution really is to make the timely filing of your audited financial statements a prerequisite for getting further federal funds. And that would really concentrate people's attention to delivering these filings. I can tell you that North Carolina in the last month passed a law that has now made sales tax distributions to local government contingent on filing an ACFR within a year, which I think is pretty relaxed. And then Utah has had a long-term policy of conditioning distribution of funds to a 6-month filing timeframe. Heterogeneous accounting standards. So in the private markets, we have FASB. In government world, we have GASB. And for many people, that's where it all ends. But the fact is that there really is no national requirement to use GASB standards. And in several states, including the ones I've listed, it's pretty unusual for local governments to file GASB-compliant financial statements. A lot of times these are cash-based or modified cash-based. You don't really find any information about long-term liabilities, such as pensions and other post-employment benefits. Then you have some governments, including a couple in California, several in Illinois, a few in Michigan, that follow like a modified version of GASB. So they've not implemented GASB 34, which is the standard for financial statement filing that includes the full accrual balance sheet and income statement, which we call in our market the statement of activities. So there's a wide array of compliance and non-compliance, and that undermines the idea of that spreadsheet that I showed you earlier, because we would be looking at numbers from an accrual-based entity and trying to compare them to a non-accrual-based entity. So we're really looking at apples to oranges. One thing that could be done here, and this is quite a stretch, I have to admit, but it is a policy idea that I'd like to float, is that the OMB, which oversees the single audit process, could require GASB adherence. I mean, right now what happens is if I look at a New Jersey local government financial statement, I'll see an audit point saying, well, this does not meet generally accepted accounting principles. Well, why don't we go further to say, well, we as the federal government are not going to accept an audited financial statement that does not meet GAAP standards. A harder one still is the lack of a standard classification method for revenues, expenditures, assets, and liabilities. States have standards. So, for example, Florida has a fairly granular set of accounts that are based on GASB, but then go much further into detail. We've seen charts of accounts in other states. Some of them are required, but more generally they're voluntary. The Census Bureau imposes some level of discipline because when the census sends out their annual survey of state and local government finance, there are categories for revenues and expenditures. They're fairly high level, but maybe they would be functional. So perhaps the way that this can be dealt with, I don't think this can be dealt with in a mandatory sort of way. I think it has to be really handled voluntarily. But perhaps the census could get together with various states and come up with maybe a somewhat more granular level of the already used census standard, which has really been enforced for decades now, and perhaps have something where maybe smaller entities could just produce the actual census categories, which they're already required to do every 5 years, or more advanced entities could have a more granular set of categories that they could report. This one is really amazing, and I've worked on this for quite some time personally, and I think there's several people in the room I've hit up for funding for this particular project. So the idea is that while we continue to be in the world of PDF-based ACFRs, could you just go to one website and be able to find all the ACFRs that are out there and then just download them for free and without going through and I'm sorry to say, because I know people from MSRB are in the room, but the fairly complex navigation that you have to go through with Emma. So is there a way to simply, I want to see, Compton, California's ACFRs for the last 10 years. I know I can't, but if I could, I'd like to be able to just go to a website and be able to just type in Compton, California and see all that. So there's some hope. The Federal Audit Clearinghouse, starting in 2016, produced all of the single audits online, and I have used up my time. So I guess I'll take more information, more comments or I will respond to more things during the Q&A. Thanks.
I'd like to call up our discussant, Ahmed Abonama.
Great, thank you. Good morning, everyone. It is a pleasure to be here. Long-time attendee, first-time speaker. And I'm really happy to share some thoughts on Mark's paper. As I'm sure a lot of you know, this is a topic that Mark has been vocal on over the years with respect to disclosure in the municipal market. And, it's a topic that in my career as a bond lawyer, as staff at the SEC, and now as the finance director of the city of Cleveland, I've kind of seen from a variety of different angles and have what I hope is a unique perspective on the discussion and some thoughts that can help move the dialogue forward in a way that can be productive for the future. So first, I think at the most basic level, absolutely a believer in any discussion that is about improving the availability and quality of disclosure in the market. It's essential for the efficient functioning of the market. It's something that when I was at the commission, we worked really hard at accomplishing through in both the primary market and the secondary market with respect to additional event notices under Rule 15c212 to make kind of private debt obligations more transparent to the investing public, but also in the secondary trading market with respect to markup disclosures to give investors a greater sense of what it actually costs them when they're transacting in municipal securities. Something that per investor surveys, most investors had no clue that a trade even costs them a penny, let alone many, many multiples of pennies each time they executed a trade. So the extent to which Mark in this paper really adds to that dialogue, I absolutely applaud the effort, and I think it does enhance the discussion in a meaningful way. And so as Mark just walked through, he raises 6 shortcomings with respect to municipal disclosure. He discusses potential solutions and some recommendations and some possible objections to those. What I'll do is I'll address kind of each of those 6 shortcomings in turn, offer some thoughts on the discussion of those topics in the paper, and then offer some broader thoughts in the aggregate of the presentation. And I'd also note, I take some pride in being the only one without a PowerPoint today. You might be able to tell that I'm a lawyer. So the first shortcoming, the lack of these effective and freely redistributable standard identifiers. I really think that there are 2 issues embedded in this one. One, the absence of a single issuer/security identification convention, and then also a convention that is freely and readily distributable without having to pay for licensing fees, et cetera. This is a topic that I see some former SEC colleagues in the room. We dealt with frequently in our time together. And I would just say a couple things. One, have no objection to a system that is more comprehensive and uniform, where we don't have multiple QSIP 6s for the same issuer, and a system that is freely distributable and easy to access. I think the devil, of course, is in the details. Even the author points to the UEI identifiers that the federal government has set up, and that's no panacea. The city of Cleveland has 5 UEIs. So it's not clear what the actual solution is there that could create a really clean single identifier at the issuer level, and then security level identifiers. And then what I expect would be needed is for issuers that have different credits within the umbrella of the larger issuer, like the city. We have a water credit, we have a pollution control, airport, another identifier that can segregate those separate credits from our general obligation tax-supported credits. And so the only real advice on this that I would offer, a caution, is we should avoid baking into any future regulations a specific service, a specific provider. And if the regulators were to take this up, really encourage them to set standards so that we're not saying, okay, Bloomberg's tool is what we're going to use now. Well, what happens 10, 15 years from now if Bloomberg decides to not be so generous with its freely accessible identifier? I'd also note that this is really a market convention, and it's up to a certain degree, the market participants who are using this QSIP convention to determine that they want to use something else. At a certain level, this is wholly within the market's control. I would also note just the cost and the burden of some kind of a change like this, which on the upfront for the issuance portion would be relatively easy and simple. However, the MSRB's EMMA system is built, the infrastructure is built based on the QSIP identifying convention, and to pivot from QSIP to something else would come with tremendous expense, burden, and disruption to the functioning of EMMA. So I would just encourage the author to think about that issue and how we could work through that as a market. So second, with late filings, I mean, look, they happen. We had MCDC. We know that sometimes they never happen at all. They happen for myriad reasons, and I don't think that anything is going to change that. Probably the best way to address late filings would be through some really significant and major and incredibly controversial changes to the regulatory framework of the municipal market, which I don't think we're here to discuss, and I did not bring the right protective gear to have that conversation. And so this is a tough one where the deadlines are clear. The regulations are not vague. You have 10 business days to file a material event notice. You have a filing deadline in your continuing disclosure undertaking to file your annual consolidated financial report. I think the issue is a complete lack of market discipline in the context of knowing that there is almost always an imbalance between supply and demand. And so that market discipline is really hard to impose on the broker-dealer side. But without that kind of discipline, without the market and the folks with the capital who are investing conveying to issuers who are not fulfilling their disclosure obligations that there is a penalty for that failure, the late filings, the issuers that say, we're fine. We were late a year, but we still got great pricing on our last offering. There's no market communication that's conveying to them that this is a real problem, other than folks like us in a room sort of acknowledging that theoretically that this is a problem. So the third, I'll address the combination of the heterogeneous accounting standards, classification methods, and the PDF-based reporting, because I feel that these kind of fit together conceptually. And I do believe this is where the paper really could use some more thorough discussion of how we could get this done, and why we should get it done, and what the costs and burdens would be on individual market participants and then the market more broadly when we're thinking about any structural changes with how the MSRB collects information, et cetera. And, a couple questions for the author. Is homogeneity the objective here? If it is, how do we get there? Would we be trading one version of heterogeneity that is kind of jurisdictionally based with another version that is dependent on the kind of issuer we're talking about? Is it really conceivable to have a single set of standards for a market that is as diverse as this? I think there's a note in the paper about the number of municipal issuers really being at about the 36,000 mark. That's a lot. It's compared to the public company number, which is, I believe, under 4,000 now. And so, there's a sense of scale here that we have to wrestle with, and a sense of complexity, given that you're a governmental entity and you're a governmental issuer, no matter how big you are, if you enter the capital markets, whereas, it's pretty easy to choose not to be a public company these days. I'm running short on time, as always. I'll jump ahead, and I was really interested in the Tower Amendment discussion and how it related to some discussion in the recommendations and some of Mark's comments when he was on the stage. Reading the discussion about the Tower Amendment, it came across to me that this was really a securities law discussion, that we were looking at the securities laws to be the tool to get this kind of disclosure out into the world. But then when we get to the recommendations portion and we listen to the remarks, we're talking about the Federal Audit Clearinghouse and OMB. And I think acknowledging that distinction between the source of authority and who is able to request what and require what of municipal issuers is really important. The 10th Amendment, the Tower Amendment, is a distinctly securities law question, and I think has really interesting possibilities if that the paper could explore in terms of the true scope of the federal government's authority, the real words in the Tower Amendment, and what that could mean for future regulation. So my time is up, and with that, thank you.
Mark, do you want to respond to Ahmed's comments?
I do, if I can figure out how to turn on the mic. Is it on? All right, there we go. I need the technical support. Thanks very much, Ahmed, for taking the time to read it and comment. With respect to Bloomberg's involvement, Bloomberg has given up ownership of the Figgies. So that really now exists in the public domain. I take your point about disruption to Emma. I think that's definitely something that needs to be considered. With respect to the varying types of issuers requiring different kinds of reporting, I mean, I ran out of time. I didn't really get into discussion of XBRL, but XBRL taxonomy can include really an unlimited number of revenue, expenditure, asset, and liability concepts. So there's no reason that one taxonomy couldn't handle a lot of different types of issuers. However, it's also possible to have multiple taxonomies. So if we decided, for example, that there needed to be a special taxonomy for transit agencies versus general purpose governments, that's also possible in terms of implementing FDTA. And I think Ahmed correctly points out that I do a lot of conflating of different regulatory regimes. So let me just be clear that any entity that receives and expends $750,000 of federal funds has a filing responsibility with the federal government, as part of what used to be called, I think it's now called 2 CFR 200. It used to be called Circular A133, which is promulgated by OMB, and that is a way to regulate. And there is an act called the GREAT Act, which was passed in 2019, which mandates the use of machine-readable disclosure for those single audits, but we have not yet seen that being implemented. Thanks.
Awesome. You know, the goal is certainly laudable. Who wouldn't want more timely, easy-to-read financial reports in the market? But before passing it on to the audience, I just need to raise one question. You know, you do mention that there's about a half a dozen states that don't conform to GASB, and I can't help but think about the unintended consequences if there was some sort of federal mandate out there that all of a sudden, you know, New Jersey and miscellaneous other states need to now conform their documentation. Who's going to do that? So we have local units of government with very limited human capital resources. They'll be the net loser here because they're going to have to pay for the change. And then on top of it, the net winners theoretically become the financial advisors, municipal advisors, auditing firms, and technology firms that get to capitalize on the need to completely change a financial model that I'm not saying it's great or not great. I have a completely empathetic on it. My point simply is that there's a huge tax burden here, huge financial costs, unintended consequences as we move toward this goal of more efficient disclosure. That's my comments. I'd like the audience now to respond as well. Go ahead.
So I just want to add one thing to the late filing topic, which kind of came up yesterday as well. There was an S&P action a couple months ago where they put 149 municipalities on negative watch because they hadn't submitted timely AgFirs. One of the reasons they cited is that there's a vast shortage of CPAs in this country. And I did a little bit of a dive on that, and it is extending to the corporate world as well. And if you look across some of the discussions we've had in the last couple of days, there's shortage of construction workers, there's shortage of teachers, there's shortages of daycare workers, et cetera, et cetera. We have a pretty major crisis in this country, and this extends into the municipal market and its ability to get timely information out.
Yep, I can just yes, it's a real it's a real challenge. You know, in Ohio, we were a little bit buffeted by that because the auditor of state is the auditor of record, unless it relinquishes the audit. And we've had the good fortune of being audited by the auditor of state the last 2 years. But even that comes with timing challenges as well. We really had to negotiate quite vigorously to get them to hit our deadline of posting our AgFir. And they initially balked, and it took nearly a call to the governor's office to get that to happen.
Can I just, on that, so in North Carolina, that argument came up when they passed their enforcement requirement. So there are 600 governments in North Carolina that have to file with the state, and there were 25 or so that are more than 1 year delinquent. So somehow, despite the shortage of government accountants, 575 governments in North Carolina were able to figure out how to comply with this requirement. One reason why we specifically are going to face a greater shortage of government accountants is that the industry is not keeping up to date with technology, right? So your ability to use your skills elsewhere gets less and less as you fall further and further behind what's going on in the corporate accounting world.
I think that comment, though, goes right back to the earlier comment, the earlier panel that Steve moderated. It's just not politically expedient to necessarily spend your cash and limited resources on improving financial disclosure or financial reporting models within a particular municipality as opposed to paying for that extra police officer or that extra teacher. And therein is that conundrum that continues to perpetuate in these markets. Next question.
Corby Deer from Bloomberg Open Symbology. I wanted to echo what Mark had noted, that Bloomberg does not own the intellectual property or the copyright of Figgy. It rests with the standards body who have adopted Figgy. Within the standard itself, it is written under the MIT open source license, which guarantees its perpetual open source Bloomberg cannot charge. Bloomberg cannot generate revenue from OpenFiggy. It is Bloomberg's security master identifier. It is our primary key within our data sets, but we do not own the intellectual property of Figgy for that. With respect to the impact on the Emma website, we had a very nice conversation a number of years ago when Emma was going under its facelift for its website. We had made all the appropriations for a mapping service exclusively for the Emma website. The impact to the MSRB in the mapping of CUSIP to Figgy is minimal. We actually provide it on the website through an open source API, freely available. And in terms of the FDTA impact, if the specific section where it actually calls out the identifier section, it does not name Figgy, but it describes what the identifier should be. One, it needs to be a standard of a recognized standard body. Two, it needs to be open sourced and unlicensed. Three, it needs to be machine readable. And four, it needs to be freely redistributable. You have CUSIP and you have Figgy. Only one of those identifiers meets the standards of the criteria of the FDTA. It's what Figgy has done to CUSIP is what LEI has done to DUNS. And that type of comparison, I think, hits home here in DC. It is basic reference data, non-proprietary, and open sourced. So I just wanted to touch on those three things.
Next question.
Hi, Matt from UniChain again. Well, a lot of echo. Mark, to your point about the muni market falling behind in technology, the FDTA actually states artificial intelligence if you read the summary. So my question is, generally speaking, if you think about the aggregation analysis of PDF documents, how do we all envision these emerging technologies playing a factor in the years to come?
Well, I think there are some people in this room who've forgotten more than I know about artificial intelligence, but my understanding of how things like ChatGPT work is they work on a corpus of data. And so if we don't have clean data going into models, we don't have useful outputs because garbage in is associated with garbage out. So cleaning up our data, especially at source, is the way we get better data and better governance over the municipal market.
We have time for 26 seconds worth of a question. Anybody taking that? Go ahead.
Well, 26 seconds, I've got to formulate a question really quick. So, Emily Brock with the Government Finance Officers Association, thank you so much for the information. Been deeply involved in this conversation. At GFOA, fundamentally, we practice, we focus generally on creating best practices. That is, when good things are done, good things happen as a result. A carrot instead of a stick. And Yafa, to your point, if things are kind of pushed upon us and imposed upon us as opposed to sort of a natural underpinning of how might we be able to learn this technology, formulate this technology, and create a municipal market that's a $4 trillion market that underpins our economy across our country, we're heading in that direction. I think it's probably out of the scope of reality to think about it implementing in 4 years. But certainly, I think it's worth a mention that there are really good things happening in technology at local government levels, especially in financial reporting, as we move forward. So that wasn't really a question. That was a point. That was a statement. But hopefully, any comments?
I'd like to. I would just like to, associate myself with the position that GFOA took in 2009 when it said in its best practice for web presentation that local governments should adopt XBRL when it became feasible to do so. And so I think that was great. I think it was also great that until 2017, GFOA provided the financial indicators database, which aggregated about 70 data points on 4,000 governments. And so I think GFOA has done some great things in the past. And I look forward to working with GFOA to do some great things in the future to implement FDTA. Thanks.
Awesome. Thank you so much. I know if I don't keep everybody on track, I'll never be invited back, and this is way too much fun. So next we have Lisa Knauer And she will be discussing private activity bonds as investment subsidy, evidence from the 1986 cap on bond volumes.
Okay, so thanks a lot for having me. I'm super excited to present my paper on private activity bonds as investment subsidy, in which I'll derive evidence from the 1986 cap on bond volumes here today. So as you can infer from the title, the main focus of this paper will be qualified private activity bonds. Those are tax-exempt bonds issued by US state and local governments on behalf of private sector firms with the ultimate goal to foster local investment and employment. The US state and local governments thereby only act as the conduit issuer, not taking any liability of those bonds. Due to the tax exemption, those bonds are substantially cheaper than standard corporate bonds. And to give you an upper bound of this cost advantage, in the 80s that I'll study in this paper, the relative difference between top-rated local government bonds and corporate bonds was about 2 percentage points, which gives a relative cost advantage of about 20%. So that's quite. This is an upper bound, but this is quite substantial, and making it a very cost-attractive tool of financing for corporations. The overall size of this private activity bond issuance market is quite large. In 2019, it constituted for about 25% of overall issuance, and it was way larger in the 80s, where it constituted for more about 50% of overall issuance in this muni market. From a political point of view, those private activity bonds are often controversially debated, mainly due to federal tax revenue losses that are associated with it, so that this tax exemption for private activity bonds was often very close to being terminated, but still exists today. Despite the political attention and also like the overall size of this of this private activity bond market, relatively little is actually known about those private activity bonds from the beneficiary side, so from the corporations that are the ultimate recipients of those proceeds. Therefore, in this paper, I'm trying to provide evidence or insights on the corporate reaction to this type of financing. And I'm basically trying to answer two questions. The first being is, how does this supply of private activity bond financing actually affect firm investment in the first place? And the second question, given that those private activity bonds subsidize capital relative to labor as an input factor, how does private activity bond financing actually impact employment in a second step? Yeah, so there might be either some substitution effect going on or some scale effect relative to how this is going to be used within the firms. When trying to estimate the impact of private activity bond financing on firm outcomes, I'm going to face multiple identification challenges, and I'm going to give you a broad overview of those challenges and the way I'm going to address them now. So, most straightforward, obviously private activity bond issuance isn't random, so it might simply reflect differences in local investment opportunities that are existent out there. Even within the same set of local investment opportunities, not all firms will demand private activity bond financing. Yeah? So there are like additionally endogenous factors why firms will request this type of financing, and it's very difficult to control for this universe of motivators that drive firms to request this financing in the first place. And finally, I have a second step of a selection issue, meaning that states also have discretion in the allocation of private activity bond financing and might presume different agendas on how they want to distribute this subsidy. To give you an overview of how I'm going to address this, so my main analysis will be based on a bordering county sample, which allows me to kind of keep investment opportunities constant, and I'm going to exploit differences in a per cap supply shock at those state borders. To address the differences in the selection into private activity bond issuance of those firms. A huge share of my analysis will be based on private activity bond eligible firms, so those that would qualify this type of financing, but are not necessarily the ones that will request it in the end. So a huge share of those estimates will be rather intention to treat effect relative to a direct effect that I will be tackling on. And finally, to address states' selection or distribution mechanisms of this private activity bond financing, I will exploit a lottery-based allocation approach for one state in my sample, which will be Texas, which will give us like a random variation in how those private activity bonds will be distributed. Okay, so let's jump into the main shock that I will explain in this paper, which is around the 1986 Tax Reform Act. Before this 1986 Tax Reform Act, private activity bond issuance was booming very crazily. So the 1986 Tax Reform Act kind of constituted the biggest shock to this private activity bond financing market ever. With this Tax Reform Act, state-level volume caps of total issuance of private activity bonds were implemented, and in particular, this allocation schedule that was implemented at that time denoted that for states with a population of less than 3 million, total issuance in these states can only be, will have a floor value, a baseline volume of 150 million in total. And for states with a population above 3 million inhabitants, those states can distribute $50 times the state population. When we use this allocation schedule and think about this on a per cap private activity bond level, this results then in the distribution that you'll see on the bottom, that we will have states with those more than 3 million inhabitants or a population above 3 million, which are then basically bound by this $50 per cap threshold and can only distribute $50 per person in private activity bonds, whereas less populous states, or the smaller ones, can distribute $150 million divided by the respective state population, which then leads to higher private activity bond cap limits in the less populous states. To give you a concrete example, for instance, West Virginia at that time had a population of about 1.8 million inhabitants. That translates into a per cap PAP supply limit of about $80. So this would be a state on the left-hand side of the 3 million threshold, whereas, for instance, Virginia had a population of 6 million inhabitants, 6 million making it bound by this $50 per person threshold, and those states are basically bordering. So we have West Virginia, which has can distribute higher amounts of private activity bonds per person, whereas Virginia could not do so and was bound by this limit. I'm going to exploit this variation in per cap PAP supply limits then in difference designed at state borders, where I will basically look at real effects on the county level and on the firm level, and those will be regressed on this per cap supply measure that I just introduced, interacted with this post period. Most importantly, I can control in the state border setting for common economic trends at the state border by using the state border pair post fixed effects. And so this will kind of, at least give me some bound on the local investment opportunities that are existent there. The main outcome variables of interest at the county level will be changes in actual private activity bond issuance, and for the firm level, I will look into firm investment and firm employment as the main variables of interest in this setting. I will have a sample period from 1983 to 1990, and I will restrict my sample to not compare the universe of counties against each other to a PAP issuing a county sample to any counties that issued any private activity bonds in the 10 years prior to the reform. Private activity bond eligible firms will come from CompuStat and are mainly manufacturing, transportation, and utilities firms. The rest is rather not so relevant for this. And to identify the actual private activity bond beneficiaries, I will make use of data from SDC Platinum, and this will be hand-matched to CompuStat in the end. So let's walk you through the different results. So in the first place, I want to establish that this state-level per cap supply shock actually translates in differences in private activity bond issuance on the county level within those states. So I'm using this state border regression framework that I just introduced, and I'm going to compare private activity bond issuance on the county level for this variation of per cap PAP supply measures. I'm going to show you the coefficient plot here. So the outcome variable is private activity bond issuance on the county level, and we see that for these different levels or for this variation in per cap pub supply. We do not see any differences in their issuance trends prior to the 1986 tax reform and after, like this new caps on private activity bonds have been implemented. We see a relative increase in private activity bond issuance when counties are in states with a higher per cap supply limit, and this effect kind of stays or increases slightly until 1989 before it kind of resolves a bit. Overall, the magnitudes of this effect denote that about a $1 increase in the per cap pub supply measure translates into about 1.37% increase in private activity bond issuance on the county level after the 1986 tax reform. Having shown that this per cap supply limit actually translates into the differences in issuance, I'm now jumping into the firm level results, and I'm first looking at how these differences in per cap pub supply limits affect firm investment, as defined as the logarithm of capex over assets in that setting. This is like a similar coefficient plot over the time. Again, we do not see any differences in investment trends prior to the 1986 Tax Reform Act or prior to the implementation of those new caps. After the reform, we see an increase and then always upward trending increase in firm investment for firms which are located in states with relatively higher compared to lower per cap pub supply limits. Talking about the magnitude effect, they are rather large, so that a 1 standard deviation increase in per cap supply limits leads to an increase in capex to assets ratio for those firms. These are the results for the private activity bond eligible firms. I can also use these regressions on the actual beneficiaries of those bonds. Given the smaller sample size, I cannot control for the state border setting there, but I also find that across the different specification for the beneficiaries, if it's either beneficiaries after the reform or firms that received a private activity bond before and after the reform in column 3 and 4, that across those specifications, I also find a positive impact on firm investment for being located in a state with higher per cap pub supply. Now, moving to how this increased investment for those firms translates into differences in employment. I'm applying the similar setting as before, so I'm looking at log employment as the outcome variable and showing how differences in the per cap pub supply impact employment over this event period. Again, we see non-significant trends prior to the reform, and after the 1986 tax reform, we see a direct increase in employment for being located in states with higher per cap supply limit, and this kind of stays rather constant in the post-period. The magnitudes correspond to about a 5% increase in employment for 1 standard deviation in per cap pub supply. This is more consistent with that there are more scale effects related to this private activity bond financing, whereas this does not provide any evidence for any substitution effect going on. In the final part of this paper, as already pointed out, I will then turn to the actual selection mechanism at the state and address concerns that actually states might select the best project within the states and that this might drive the results. Therefore, I'm making use of data from the state of Texas. The state of Texas is one of the states which have always been oversubscribed in private activity bond requests since the existence of this private activity bond program, and it's also one of the biggest or the second biggest private activity bond recipients in total, making it a good laboratory to study private activity bond allocation. The state established a lottery-based system so that firms apply for private activity bond issuance before a certain deadline and within sub-ceilings, and in January, then the state runs a lottery system and basically assigns a lot number, and depending on that number, you'll either receive private activity bond financing, yes or no. So by this, I can basically then compare lottery-winning firms to lottery-losing firms for firms which all applied for this lottery in the first place. I can only use a very limited time sample because I need to observe both lottery winners and losers in the same year, and I'm also trying to come up with the cleanest estimation of the sample so that I only consider lottery winners in the first year that I observed them in the sample, and the control group then only consists of firms which never received any private activity bond issuance in that time. The regression framework then is in a delta-based regression where I'm estimating the change in firm investment on the on the allocated bond volume over that time, controlling for lottery year fixed effects. Looking at the results, so my preferred specification is in column 4, 5, and 6, where I'm including lottery year fixed effects, basically comparing lottery applicants in the same year for this reform, and I'll show the differences over the time horizon for 1, 2, and 3 years of this reform. We see that in year 1, we do not see any direct effect of receiving any private activity bonds via the lottery. The effect seems to kick in year 2 and slightly increase in year 3, meaning that this random allocation of bond volumes via the lottery is associated with a relative increase in firm investment over that time. That being said, I'm hoping to shed some light on the corporate reaction to this type of financing, providing evidence for more stimulative effect of firm investment, and showing that employment is more living up to a scale effect in that setting, and trying to provide insights on how actually firms react to this type of financing. Thank you.
I'd like to invite Igor Kanua from the University of Kentucky as our discussant.
I would like to thank the organizers for inviting me to discuss this paper. It's a pleasure to be here. So although Lisa did an amazing job presenting the paper, let me just highlight some of, summarize the paper just to highlight some features that are going to be important here for my discussion, right? So this paper is trying to answer a basic question, right? So what's the effect of private activity bonds on firms' investments and employment decisions, right? So the basic idea here is to try to test the following hypothesis, right? That either there will be a scale effect in which, by lowering the cost of one of your input factors, you decrease the total cost of production, making the firm produce more and invest more in all inputs, or a substitution effect in which, by lowering the cost of one input, the firm would substitute away from one input to the other input. So moving away from employment, investing more in capital, right? So then basically that's the main hypothesis the paper is trying to do. And of course, there is a lot of identification challenges associated with trying to answer this question, right? So one that you can think of is that the SPEBs are not randomly given away, right? So there's a selection in who receives these bonds, and so there could be an omitted variable that is explaining both the allocation of the PEBs and the decisions of the firms to both invest and employ more or less, right? So what the paper is doing to try to solve these problems is explore these caps that were established in the 1986 tax reform that basically limited the maximum amount of private activity bonds that were allowed to be issued in a given state. And it was a simple rule: if the state had less than a population of less than 3 million people, then the state could issue up to $150 million in PEBs. And if it was more than 3 million people, then it was basically $50 per people, right? So that generated a lot of distortions in the amount of available PEB, right? So basically, for example, in Vermont, it was $210 per capita, and in Massachusetts, 50, right? So $50 per capita, right? So the way that I like to think about this is not on a per capita basis, it's on a per firm basis, right? So there are fewer firms in Vermont than there are in Massachusetts, so the likelihood of a Vermont firm receiving this funding is greater than a Massachusetts firm. So basically what the paper is going to do here is compare firms in Vermont, in a bordering county in Vermont, with another firm in Massachusetts and see how they did around the 1986 tax reform. Okay, so that's basically the basic idea, and I can just summarize the entire paper in 3 graphs. You can see that the parallel trends prior to 1986 are pretty solid, right? I mean, there's nothing going on before 1986, and right in 1986, you see a big jump there in the availability of PEB funds to places where there was more a greater availability due to the regulation. The firms in these places invested more, and they employ more as well. Okay, so that's a very important question. So I have basically 3 suggestions that I would like to make to the author here, right? So one is regarding the research question and the contribution of the paper. Then I also would like to discuss, and I think this is going to be like my biggest point here, the economic magnitudes and the need for more details on the allocation of these private activity bonds. And also, of course, this is an empirical paper, so I need to talk about identification, otherwise I would just like lose my job, right? So that's why I'm here, right? So I think that, like, right, so the big research question, the overarching question that we're trying to answer here is whether or not governments should be providing subsidized credit to companies. Okay, that's the question that we want to have a good answer to here, right? And there are many arguments in favor, right? So it can stimulate the economy, it can address market failures, like maybe like these companies were not going to be able to get this credit through normal channels, and also like in a in a world with a lot of like supply chain problems, you can promote strategic industries, right? So those are the points in favor, but you also have a bunch of points against subsidized credit, right? So like I think that the main one is that maybe the government is not the best entity to decide where the money should be going, right? So you can generate distortions in this case. There may be like some cronyism or some moral hazard, like we've been discussing here a lot in the conference. And there's also crowding out of private investments, right? So I think that right now, what the paper is doing is just looking at investments, which is kind of like the very direct effect of having this subsidized credit in employment, right? I think that it already provides a pretty compelling evidence that, like, well, these PEBs are pretty useful and they can have a good benefit. But what I would like to invite the author to do here is to look at more outcomes so we can have a better picture and a better answer to this question of whether or not we should be having a subsidized credit or not, right? So here I have a laundry list of things that she can do that like maybe could help her answer this question. But just to mention a couple, right? So I would like to see, for example, the political economy of these private activity bonds, right? So, like, for example, are better connected, politically connected firms more likely to receive these funds, or firms that do like more campaign contributions, are they more likely to do that? Is this money going into really strategic industries, or is it just like the good old champion, the good old local champion that is just receiving this money, right? So I think that by looking at these details, we'll really see, is this money going into a useful and good use, or are we just like having cronyism and there's a lot of distortions there? I think this could really improve the total impact and the contribution of this paper. I think that like the biggest comment that I have here is regarding the economic magnitudes, right? So the baseline result of the paper is that a 1 standard deviation in the PEB availability is associated with a 10% increase in investment and a 5% increase in employment, right? So I think that there are 2 things that I would like to mention here to like put this into perspective, right? So the first one is that we're talking about CompuStat firms, right? So those are publicly listed firms where like the medium amount of assets is around $800 million. In PEBs, right, so I told you like the cap for Vermont, for example, is $150 million, but not 100% of the funds go into industrial development, right? So a lot of like these states prioritize housing, for example, for the use of their private activity bonds. So then if you think of like, let's say that like half of the Vermont bonds were used for industrial development, we're talking about $75 million going into these PEBs, into a $800 million firm, generating a 10% increase in investment, right? So it's kind of like hard to reconcile like the size of these things and how much this is moving this market for like these very large publicly listed firms, right? So basically, right, so and again, one thing that is very important here is that this is not government expenditure, right? This is just subsidized credit. So you're basically just subsidizing the interest rate of that loan, and this is having like a big impact, right? So then like if like I think that the conclusion here is that if just a simple intervention can generate such big investments, we should be doing way more private activity bonds, right? So I think that could be the conclusion, but I'd like to take some caution here, and before jumping to the conclusion, I'd like to ask the author to dig a little bit deeper into this and try to explain to us why these results are so big. What's happening here that is causing these large numbers, right? So do we have such a large financial constraint that there are so many projects just waiting for that small decrease in cost of capital to be funded, right? So that's something that I would like to understand. Or even more, I would like to know who is receiving that, right? So what are the projects that are receiving this type of money, and why didn't the just conventional financial markets weren't able to actually fund these projects, right? So I think that understanding more who is receiving and why they're not receiving from the capital markets would really help us try to understand why you're finding such big numbers, right? So I think that answers everything. Of course, as I said, there is an identification result. I'm not going to spend so much time here, but I'm not a huge fan of the neighboring county, and I told this to Lisa earlier. I'm not a huge fan of the neighboring county identification strategy for this setting. I think the neighboring county identification strategy is really good when you have a shock at the county level. Here, what she has is a shock at the state level. So the money, the variation is at the state level, and the money has to move from the state to the county, from the county to the firm, and then the firm has to decide to invest or employ more, right? So I think that there are many steps here where things can go wrong and where she can have measurement error here. So I would encourage her, maybe that's my opinion, but encourage her to move away from the neighboring county identification strategy and focus more on her firm level results, which I think are really good, and more specifically speaking, the lottery results, right? So she has a bunch of lottery results that are very good because now you know that you almost have an experiment there, that the allocation of the funds were randomly assigned by a lottery result. So I think that she can bring these results up to the front of the paper and then discuss more based on these baseline results here, right? So I am running out of time, and just time flies when you're having fun, right? So I just wanted to say this is a very important question, right? So many governments all over the world would like to know the answer to this question. So I applaud the author for that, and I just would like her to push more a little bit on these three topics that I mentioned. Thank you very much.
Lisa, would you like to respond?
Yeah, so. Okay. Yeah, so thanks a lot to Igor also ahead of the conferences for providing all these insights. It has been very helpful already in addressing some of the current issues in the paper. I really like your idea of putting the identification further to the firm level so that we can actually really learn more about the beneficiaries themselves. I'm currently already trying to pursue some avenues there to shed some insights more on this. Regarding the economic magnitudes, totally fair that one needs to kind of relate it to this effect sizes. My current take on this, and this is something that would need to be explored more in detail, is there might be a lot of things going on, but there could be some signaling or enhancement effect that this getting this private activity bond financing spills over to additional conventional financing, but this would be something that would need to be explored more in detail, and I'm hoping to shed some more lights on. And the underlying mechanisms that actually drive those results. I mean, we can more think about that you would kind of ramp up an additional production facility in this context, and so this might be relevant there. And regarding the contributions and the different mechanisms, I would say that a lot of the points that you mentioned are some of them are addressed in the lottery results, which is why you and I presumably like them more. So I'll try to pursue some of them more in that respect. And yeah, I'm looking forward to addressing all your comments in the upcoming version.
Awesome. Thank you, Lisa. There's one thing that I can't help but mention since it resonates so loudly with me. There's a key distinction between PAB allocation and PAB execution. So by that I mean, just because Company X got a PAB allocation to issue, I'm making this up, $20 million, it doesn't mean that they'll ultimately be successful in issuing those bonds, that the mutual funds or any potential investor will ultimately approve the credit, and that credit ultimately clears in the market. And in fact, what we're seeing even, in 2022 and 2023, that deals are not getting done, particularly those with private activity bond allocation. And so the states are now going to, their wait list of entities that want PAB allocation and now giving them PAB allocation that was unused in a particular calendar year. So my question for you, before turning this over to the audience, is when you look at theoretically what happens in Texas where there's a lottery approach, were you able to strip that back and say, was that those deals that cleared that ultimately are being assessed, meaning that they did, investors believed in them and then they had impact, or was it based off of any PAB allocation? Because I think if you strip it back and you say these are the deals that cleared, but it was really deal 10 and 15 that cleared and not deals 1 through 10, I think ultimately you might see a significant distinction between your lottery approach, or actually your distinction between your lottery approach and your non-lottery approach will be completely muted.
That's a very good point. Thanks a lot for pointing that out. I need to say I don't have any insights on that yet. Regarding the Texas results, the only things I can say is that, so I have the data until today for this lottery, but I cannot even use it after 2001 because I cannot observe like this lottery losing firms, right? So that kind of adds to what you have been saying with the projects being in line. I'll definitely have a closer look at this and hope I can shed some more light.
Yeah, I encourage you really to do that.
Yeah.
I don't want to take any more of our 6 minutes, so please, Kent.
Just following up on Yafa's excellent question. I'm sorry. Following up on Yafa's excellent question about the gap between allocation and potentially issuance, I wonder, it seems like you're treating the PAB market monolithically, and it comprises a vast range of different types of bonds. And you use the word firm or corporation. Probably the majority of PABs don't involve a firm or a corporation. It's mortgage revenue bonds, private universities, colleges, not-for-profit hospitals. And then there are a whole range of cats and dogs corporations. So I just wonder if you were to distinguish those broad categories, perhaps student loans back in the period when you were doing the research was also a large, and there's no corporation for student loans. So I'm just wondering what the impacts would be if you disaggregated it and looked at categories of PABs.
That's a very good point. So I didn't go into that into detail, but there are different types of bonds and different sub-ceilings within the states that those private activity bonds go to. And today, actually, the largest share of bonds goes to the housing sector, to social housing, which is actually not captured by those analyses which focus on composite firms. So those are more the bonds in the category for exempt facilities and the small issuances. I cannot observe any effects on the different categories that you say so on the firm level because I don't have any data on the hospitals, and not all of those bonds also fall under those thresholds, right? For instance, 501(3)K bonds are not even capped, so that there is no limit on this. I agree that it would be more interesting to see how the different development and also to shed some more light on how the allocation changed over the years within the states. In the 80s, I need to say that the corporate sector received a larger share than it did today. For instance, in Texas, we see that there was a huge jump between 1996 and 1998, where before almost 50% was allocated to like exempt facilities, and afterwards only like about 30%, which was a huge chunk. And today, a lot of states could already fill all their limit with housing bond applications. Yeah, so this is something that would clearly need to be executed or looked into into more detail, but it might also call for this presumably a relative increase if there are beneficiaries on the corporate side which actually realize interesting projects, which are basically currently driven out of this market because of these differences in the scheme. But yeah, very, very fair point, and I will definitely provide some more insights in the paper on how this changed over the time. Yeah.
Next question.
I have a institutional background question. Is there any requirement on maturity?
Yeah, there is a maturity level. I think you can only issue 120% of the project's lifetime. That's, I think, the cap on the maturity level.
Next question in the back.
I'm Ehsan, and regarding the point that Igor mentioned about the efficiency of these investments, I'm wondering if you have looked at the default rate of these bonds and whether they are different compared to like other regular type of mini bonds, which could basically speak to the like over-scaling of these companies. Thank you.
That's a very good point, and I haven't looked into this project there in more detail, but I know that the default rate is higher than in conventional municipal bonds. So those projects are simply more riskier, given that they are secured by private sector projects, and this is also why like this yield gap is only an upper bound that I pointed out, and the true gap is smaller given the riskieriness of this project. Yeah.
Next question. Okay. Thank you very much, Lisa.
Thanks again to you.
Do we need to turn that TV on? Oh, he's not going to listen? Oh, he's listening. I got you. Beautiful. Okay. Thank you, everybody. We're now on our third paper for this session. We will be discussing the double benefit myth, disallowed interest expense, and inefficiency in the municipal bond market. I'd like to call Adam Looney from University of Utah.
Awesome. Okay. Thank you very much for the opportunity to be here today. So my paper is about the Internal Revenue Code Section 265. That's a provision of the tax code that prohibits or denies tax deductions for costs associated with producing tax-exempt income. And I'm going to talk about how Section 265 affects the municipal bond market. This is an obscure but consequential element of the tax code because its formulaic disallowance of interest expense of banks in particular has mostly banished banks from participating in the market for municipal bonds. These rules were imposed in the mid-1980s, and in that period, the fraction of municipal bonds that were held by banks went from 40% in the late 70s to less than 10% in 1990. And made the market a retail market with all of the challenges that we learned about earlier in today's conversation. So it was a consequential change. Banks are pretty good at making loans, especially in complicated circumstances. They have deep pools of risk-taking capital. They have expertise in underwriting in their local markets, certainly more so than do retail investors. And so I think that their absence surely contributes to the higher than necessary spreads that are paid on municipal bonds. And what's more, I think that this law change was based on a misguided theory that banks were earning a double benefit. excessive profits because they were both receiving taxes income and because they were deducting the interest expense associated with that. I think that theory is just wrong. It makes no sense in theory. It has been known to be false, I think, in financial circles for academic circles for decades, including by people who are in this room. And empirically, it just doesn't seem to be accurate. And so what I wanted to do in writing this paper was to raise this as an issue, to emphasize its consequences, evangelize about some policy solutions, and to encourage more discussion of this issue. So to that end, I'm just an outline. I'm going to tell you what the Internal Revenue Code Section 265 says and does. I'm going to show you how it forced banks out of the market for municipal bonds. I'm going to talk about the motivation for the rule, this idea that there was a double benefit. I am going to use the tools of algebra to expose this myth and give you some numerical examples. And that's going to illustrate that only when banks are allowed to deduct their interest is there a level playing field between taxable and tax-exempt bonds. And in the absence of that deduction, there's a penalty on banks that invest in municipal debt. And so when they're denied that deduction, there's a penalty that makes them not want to invest in that debt and to hold it, and that's why they got out of the business. I'm gonna describe some consequences of that for the market and describe some options. So there's a lot to Internal Revenue Code Section 265. I'm not going to go through all of the details, but the key part is that it says that in the case of a financial institution, no tax deduction shall be denied for that portion of the taxpayer's interest expense that is allocable to tax-exempt interest. The elements of this have been in the tax code since we have had an income tax. It was codified in 265 in the Tax Reform Act of 1954. It's a very old set of provisions. I'll circle back to the motivation in a second, but it was intended to prohibit certain forms of tax arbitrage. And prior to the 1980s, banks were basically able to circumvent these rules by saying that their interest expense wasn't allocable to the taxes and bonds that they did hold. And then in the 80s, Congress changed the law. And in 82, it imposed a haircut formulaically that said you're going to lose 15% of your interest expense that's allocated. In TR 86, it imposed a 100% disallowance. So basically what the rule says is that if a bank invests 10% of its assets in tax-exempt bonds, then it loses 10% of its interest expense. And that was a big deal. So, it caused banks to stop investing in municipal bonds. So here's the long-term fraction of all municipal bonds that are held by banks. In the immediately before the 1980s, banks held more than half. Or in the 1970s, they held half of municipal bonds. It was in the high 40s just in 1980. It had never been below 25% of municipal bonds at any time prior to the 1980s. And then after these changes, it's never been above 15% and typically was below 9%. And so there's a lot of ups and downs that are about cyclicality of bank profits, differences in marginal tax rates, the invention of the mutual funds that invest in tax-exempt bonds. But this is a big change, and even today, banks are only minimal players. And to the extent that they participate in the market, it's often in taxable municipal bonds, or I'll describe briefly later, bank-qualified municipal bonds. And I'll circle back to this later, but it's now a retail market, and there's an absence of these large, sophisticated financial intermediaries in the market. And I'm going to argue later that was a bad decision, a bad development. Before that, I wanted to just think about the premise of why we have this rule, and to describe why I think it doesn't make any sense. So the then called, I think, General Accountability Office or General Accounting Office issued a report in 1988 that described the changes that were imposed in 1986 and kind of described why they were necessary. And so the concern is that a taxpayer could accrue a double benefit by deducting interest paid on money borrowed to invest in tax-exempt securities. And I think that, like, I use this quote because I think it's representative of what people think about this market. So when I would go around the Treasury Department or I talk to my colleagues at the Joint Committee on Taxation, and I was like, well, why does this rule exist? And they say, there's a double benefit. And I was like, well, what is the double benefit? And then they would say, bank receives tax-exempt income, and then bank gets a deduction for deducting the expense. That's two. As if, like, I had made it through life not being able to add to two. And, like, so there was, like, not a deep theory of, tax incidence at work here, underlying the hypothesis and quantifying it. But fortunately, GAO gives an example, which I highlight here. And the numerical example shows that, in the example, the taxpayer borrows $100,000 at 5%, invested in municipal bonds, which also pay exactly 5%, and thus get $5,000 of interest tax-free and a tax deduction of $5,000 that gets them a tax benefit. And I think the basic problem here is that this is not an example of a financial market equilibrium. The basic reason is that arbitrage encourages investors to purchase securities up to the point where they earn the same after-tax return on taxable and tax-exempt bonds. That means either that the yields on tax-exempt bonds are below the yields on taxable bonds, or that the price paid for a tax-exempt bond is equivalently higher than the $100,000 paid for the taxable bond. So this is like a financially impossible example. And in fact, what I'm going to show you in a second is that if the after-tax returns on taxable and tax-exempt bonds are the same, then not only is there not a double benefit, there's not a single benefit. You get the same. You get the same, right? And so, again, I'm going to use algebra to describe this. So, let's say that arbitrage requires that the return on taxable bonds is the same after taxes, the return on tax-exempt bonds. RT is the yield on taxable bonds. RE is the yield on tax-exempt bonds. T here is the tax rate. The equation above says that the after-tax returns have to be the same. Well, if our bank borrows at a deposit rate of RD, that's the amount that they pay on a deposit, then in order for the bank to earn the same amount investing in a taxable bond as it does if it invests its deposits in a tax-exempt bond, then it has to be able to deduct its interest. So like that final term in the right corner is this deduction for the interest it's paid on its deposits. And if it is denied that deduction, then there's a penalty. The return on taxable bonds is always greater than the return on tax-exempt bonds. And so a bank's never going to want to hold a tax-exempt bond. So that's the algebra. I'll give you some examples. So I've just pulled some numbers for municipal bonds, corporate bonds, deposit rates. I have to say that in the spirit of this market being totally inscrutable, it was very hard to find useful numbers to provide this example. So I've used a Moody's index of seasoned AAA bonds. The recent yield on these taxable bonds was 4.77%. MBIS uses EMA data to have an index of investment-grade bonds. Those paid last week 3.14% on similar maturity bonds. The deposit rate, the 5-year CD rate paid according to bank rate and published in the Wall Street Journal, I don't know if that's a good source, but I think it's a good source, says that banks are paying 2.86 on a 10-year deposit, or sorry, a 5-year deposit. And so if we just go through the math, focusing on the first column, if the corporate bond yield is 4.77%, you can think of investing $100 in that bond. They earned $4.77. They paid $2.86 on the deposit. They earn a pre-tax spread of $1.91. They pay tax at the 21% marginal tax rate for a C corporate bank, 40 cents. They earn an after-tax return of $1.51. Well, column 2 is, let's say that they instead invest in a tax-exempt bond, but they're allowed to deduct the interest. They only earn $3.14 on the bond. They pay the depositors. Their pre-tax income is only 28 cents. But they get a benefit, a tax benefit, of being able to deduct the interest that partially compensates them for the fact that the yield is so much lower on the tax-exempt bond. That means that their after-tax income is 88 cents. And I guess the first thing to note is that the reason that they earn less on the tax-exempt bond is, in this example, is because their marginal tax rate is 21%, and the equilibrium in the market is determined by the individual investor that has a tax rate in the 30s. And so they're never going to be quite equal, given that the C corporate bank rate is lower. But if you go through the math in the right-hand column, they earn way less on the tax-exempt bond if they're denied the interest expense. And so I can give you, this is a general result that there's this tax penalty. I can give you some sensitivity analyses. If the investment yield is higher, they earn more, but there's still a tax penalty. If their interest expense cost is a percentage point lower, they earn more on the taxable bond. They earn more on the tax-exempt bond if they get a deduction, but they are still penalized in effect. The return is lower on the tax-exempt bond. If the spread between taxable and tax-exempt bonds is narrower, then the column 1 and column 2, the return is more similar, but there's still a tax penalty if their interest expense is denied. And then the last thing I just wanted to show you in this is that if C corporate banks faced a 34% marginal tax rate instead of a 21% marginal tax rate, more similar to the marginal investor in the retail market in municipal bonds, then they'd earn the same on a taxable bond and a tax-exempt bond, but only if they could deduct the interest on the deposits that were used to invest in that bond. If not, then it's an unattractive return. So why is this a problem? Well, I think the exodus of banks has meant that today's market is a retail market. It's characterized by high tax-adjusted spreads, high transaction costs. There is a large literature that has examined, what's going wrong in the market for municipal bonds. And I will give a couple examples. There's the Ang et al. Strand of research from a decade ago that says it's illiquidity, that bonds rarely trade. When they do, it's over the counter. Am I out of time?
You've got about 15 seconds.
15 seconds. Okay. So one theory is it's illiquidity. One is that it's high credit spreads. I have to say I don't really care. I think in either theory, the fact that banks aren't in the market suggests that the market's worse off. They reduce credit spreads because they're good underwriters. They bring pools of risk-taking capital. I think they're better traders. I think even more directly, there's substantial evidence about the involvement of banks in this market that suggests that the participation of banks improves outcomes. And I'll give a couple examples. One is Alan Kruger's paper about Build America bonds, which suggests that BABs were issued at spreads that were more favorable than municipal bonds. And I like this example because we basically created a new financial product to appeal to banks to solve the problem that we made bank investments in traditional municipal bonds unattractive. And then more recently, including a paper that was presented at the last conference, I think in 2019, D'Agostino's paper, suggested that bank-qualified bonds issued by small issuers that banks are allowed to hold because of an exception, they trade at lower yields and they're issued at in kind of higher volumes than otherwise would be because they can be issued by banks. So I think that this suggests that we should have more bank participation. I just want to close to say a couple ways to do this. One is we can just throw away the old 1980s rule. I think that's what we should do. I think that would bring banks to some extent back in the market, not to the extent that they were in the 70s, just because the tax rates on banks now are so much lower than they used to be. But there are incremental reforms. No one's ever raised the small issuer threshold from $10 million in 1986. There's been a lot of inflation since then, and so you can imagine having that threshold be higher. In the American Recovery and Reinvestment Act, they had a rule that said if you invest 2%, less than 2% of your assets in municipal bonds, then you can ignore Section 286. And so that encouraged some larger banks to invest in non-qualified assets. And so I think that those would be good changes in the market. Thank you.
Thank you. Our discussant, Bradley Wendt from Charles River Associates, is with us on the monitor to our right. Go ahead, Bradley.
You can hear me okay?
Perfect.
Great, thank you very much. When I received the papers from the advisory committee this year to review, this was the one I raised my hand very quickly for, just because, as Adam just said, it's an issue that's been out there, and I certainly think it really deserves a reexamination. And anything that can bring efficiency or increased efficiency to the municipal market certainly warrants a great deal of attention. Adam and I, in my conversations with them, we both spent time at Treasury. I was there in the last administration for 2 years as a senior advisor. And I've certainly had seen both personally and with colleagues my share of policy proposals. So I thought the best way to approach this is, if we wanted to take this to the next level, instead of just talking about it, I think Adam would admit we're probably halfway through the journey in terms of having a great marker on the table. But now we have to talk about other issues in the paper and what else needs to be focused on. First off, I have four issues to discuss. The first one is there is a cost of providing this deduction of interest expense to broker-dealers and financial institutions. So one thing which we have to examine is the cost of that to Treasury versus the increased efficiency of the overall $4 trillion marketplace. And that is going to be question number one, because at least to my experience, nothing is going to go forward at Treasury unless it's revenue neutral. The second thing is, and Adam certainly addressed this, but the market now is 70% retail. Banks, as his slide would show, really probably represents 15%. The retail is obviously individuals and mutual funds that own munis indirectly. So at 15%, I think you have to ask yourself, even if this were implemented, how much of an impact can you have relative to what is purely a retail marketplace? So that's something else we'd have to address. Could we actually add more efficiency here by the very commendable objective of getting banks back into the marketplace? The third thing is, I think a great deal of analysis has to be done when you have two disparate tax rates. We all know that the muni curve is upward sloping. Obviously, the long end trades at a lower ratio than the short end. Marginal rates are 34%. So in theory, bonds should trade at 65% across the curve, but that simply is not the case as we can look at ratios. So the question is, how much efficiency can you create when the top quintile of taxpayers are buying the vast majority of the bonds? Their marginal rates are probably on average over the last decade, 30, 31%, plus another 4 or 5% for state taxes, versus trying to bootstrap up a 21% financial institution using Adam's number. So I don't know if that disparity in interest rates between these two parties is going to allow greater efficiency, but that's something I think would need to be addressed. The next is, since it is a retail market, everyone in this room probably remembers or are very well aware of taxable equivalent yield in terms of their discussions with brokers or just discussions in general. And all taxable equivalent yield is what the financial community uses a simple metric to decide if you as an individual, 70% of the marketplace, is buying something that is of value to you by taking 1 minus the tax rate and applying it to the muni rate as a dividing it by the muni rate and then comparing it to the taxable rate. And if you end up with a larger number, munis are a good deal for you based on your marginal rate in the current year. So, that is how munis are being purchased right now. And then, my question is, this analysis is really set up as sort of a cash and carry trade, which is the assumption is people are buying or borrowing money to invest in munis. We're going to certainly have to do some work on both the short, intermediate, and long-term yield curves so that we have some consistency in the maturities in terms of the capital costs. But I think we just have to really examine the paradigm. Is this a marketplace generally where people borrow money to invest in munis? And I realize that this borrowing is solely focused on the financial institutions who in theory would be holding these bonds in inventory and what the impact that would have. But once again, that would be a change to the marketplace, which would have to override the taxable equivalent yield metric, which is used uniformly across the board. So I think just in summary, I think there's those 4 issues to be dealt with. And if you were to point to an easy to implement policy, call it a test case, I agree with Adam fully that bringing back the 2% de minimis rule would be something that you could see what impact that has on the overall marketplace. And that concludes my comments.
Adam, would you like to respond?
Got it. Awesome. Yeah, so those are great comments. Thank you very much. I mean, a couple, just to respond to those sequentially. One is the cost of the Treasury. So the Treasury included some of these types of proposals in its Green Book in 2016. I don't know who did that, obviously. And so they had a cost. I have to say that I was, there was disagreement about how much it should cost. And so, to the point, how much revenue would this proposal lose? I would say that it's unclear. In some sense, it is a reallocation of bonds that were being held in the retail market to bonds being held by banks. And if they face the same tax rates, then basically there should not be a loss in revenue. I think at the time in 2016, when the top rate for banks was 35%, and the average marginal rate apparently on investors in municipal bonds was like 28%, there was a revenue loss. I think today it is probably different, and so I think the cost is likely smaller. Another element, it's a retail market today. How much impact would it have? And I guess I have, my strongest piece of evidence is to point at the research that has suggested that for small issuers, it seems to matter, and that they issue those securities at more favorable yields to the issuer. So at the margin in that area, it seems to be beneficial. And so you imagine increasing the number of bank qualified issuers would expand those benefits more widely. I also suspect that just even marginal participation of more sophisticated financial traders, dealers, people able to deduct the costs of carrying their inventory would be helpful in providing liquidity in the secondary market and arbitraging spreads across otherwise similar yields that is very hard to do today. There are not hedge funds or sophisticated entities that really can arbitrage by borrowing in one market and investing in another in the municipal bond market. So I think even marginal participation could, in theory, have a result. On the point about different tax clientele, I mean, totally right. And I do think that there are probably a lot of different tax clientele in this marketplace. I did not mention it in my presentation or really in the paper, but there are also not just C-corporate banks, but there are S-corporate banks. And S-corporate banks face the individual marginal tax rate. So they are much more similar to retail investors in their tax rates that they face. And so their participation would be, clearly they would be excited to participate at yields that individual investors invest in today. And I guess just the last thing is, between the wholesale repeal of these elements of 265 and the more incremental changes, there are a lot of places to start. The 2% de minimis rule, as Brad said, is a reasonable place. I would say also that the small issuer rules are another place where you could imagine helping a lot of relatively small government entities that are relatively small and have to participate in a, just a sheer number of government entities that are small relative to the amount of bonds that they issue, which is quite small. You could, I think, capture a lot of the complexity and idiosyncrasy in the market just by expanding who gets to be bank qualified.
Thank you. I have an observation that I wanted to share when I was reading your work. And there's a lot of focus and concentration on absolute percentages of bank participation relative to the amount of muni debt outstanding. And I do think that ultimately, to me, what I did when I was looking and reading what you had produced is I went back to SIFMA's handbook. And they do an amazing job with respect to presenting data back from 1980. And I just want to share with you some facts that I picked up from there. In 1980, there was just under 400 billion of muni debt outstanding, and banks held 154 billion of that. But if you fast forward till today, where there's 4 trillion of muni debt outstanding, banks actually hold 600 billion, or 4x of their original 1980 holdings today. And I thought that it was insightful that perhaps you might want to consider sharing the absolute dollar amounts, because from that perspective, banks are not a decreasing participant in the municipal space, but actually a significant provider in the municipal space. So I just point that out to you. And the other thing I would also suggest perhaps you think about is, yes, with respect to bank qualified bonds, sure, there's a little bit of a basis point differential, certainly helps some of our smaller issuers out there. But also feedback that we get, on the sell side is that there's a mismatch oftentimes between duration, right? What the banks want to invest in terms of their duration and the optimal structuring of muni financings for local issuers, 30 years and higher, to drive down their cost of capital on an annual basis. So those are just two things that I would encourage you perhaps to consider as you think about your work.
Yeah, thank you. That's great. I mean, I will look at I wish I had known about the SIFMA handbook, because I feel like that would help me understand a lot of things. But I will definitely look at the absolute levels too. I mean, banks and bank holdings have become much larger, and the level of assets has become much larger as well. So I guess I'm not surprised at the growth in the absolute levels. But I'll look at that. I mean, I think that the other point is something where I am totally, I have to say, out of my element in understanding the actual, interaction between the, how small issuers would interact with the local financial intermediary that is making them the loan. Like, I know that in the corporate sector, for example, the vast majority of, or corporate, or how to say it, in the business sector, corporate, non-corporate business sector, most entities raise their money by going to their bank and asking their loan officer for a loan. And it's, and so I guess you can tell me what happens, but I mean, I would have thought if you're a small issuer, there is the opportunity for something that is more like that than it is than going to an underwriter and issuing securities. And so I don't know what the differences are between that process, but I guess I observed that for bank loans, it's like a pretty standardized and effective way of raising money for investments.
Questions from the audience or comments from the audience? Back.
I have a question about the investor composition that you mentioned, that I was wondering if you want to invite one type of investor to the market to increase the efficiency, whether it's better to have banks rather than, whether it's better to have, for example, pension funds or banks, because as Yafa mentioned, definitely we want to have investors that they have long-term purpose in their investment, and for that maybe pension funds. If you do something and if you can change the tax policy in a way to invite pension funds, that could actually improve the efficiency more than doing something with taxes that brings the banks into the system.
Yeah, so I mean, I guess the issues I talk about here are in some ways like, well, directly irrelevant to pension funds, because pension funds as tax-exempt entities, they don't benefit from the exemption. And so in contrast to like Build America bonds, which are tax credit bonds, they get the pre-tax yield basically. And so that encouraged them and foreign investors and others to invest that otherwise. And so I think the direct answer is that this doesn't solve that problem, which is, I mean, an important problem. And they would, pension funds and life insurance companies, have very long-term liabilities, which would be natural investors in this market. And so I don't think that solves that. I think that there is a case that, if you took the limits of arbitrage to extremes, that you could have banks established to produce taxable debt to issue taxable debt and use that debt to invest in tax-exempt securities. And you can imagine kind of backing into a scenario where there was the long-term, pension fund bank that pension funds invested in and produced that. But I mean, that's kind of like a more speculative thing.
I want to keep us on schedule, so I'm going to interrupt if you want no more questions. I want to thank Yafa Ratner from Hilltop for agreeing to moderate this panel, and I hope that everybody will agree that she did a terrific job, and she should definitely do this again next year. I want to thank the presenters and the discussants. We're going to take a 10-minute break, get back here around 12:30 for our final panel, which is on the effect of COVID on downtowns and municipal finance. So please be back here shortly after 12:30. Thank you. Here, Natalie, Glenn, Jesse, and James. Hi, how are you? Nice to see you. Oh my God, we got some great pictures of that thing.
Yeah, sorry, I didn't talk to you more.
There's one that looks like he was taken for the J.P. Morgan annual report with Makeda talking to these three black kids with a logo in the back. I thought, like, we should charge J.P. Morgan.
Was it your photographers or our photographers?
Yeah. Yes. But peek quickly. It's the thing that looks like.
This is like.
Me. Everybody to sit down. Okay, we're going to get started again. If I can get people in the back to take your conversations to the hallway or sit down, please. That's all right. I'm going to start without her. So Natalie, our fourth panelist, will be right up here in a minute. I'm really pleased to end the what's been a terrific day and a half conference with a discussion of something that's been on all our minds for some time. What is the long-lasting effects of COVID on downtowns and municipal finance? I think it's an issue in almost every workplace. How much should we expect people to come to work? How much will they actually come, despite what we expect? And what are the implications for downtowns across the country of this, what could be a persistent change in the way we work and commuting patterns and so forth? My colleague, Bill Fry, a demographer in our Metro program, has recently parsed some data and from the census, and the good news is that big cities are losing only a little bit of population, but they haven't recovered from the losses they had in 2021. And he's kind of optimistic because the pace of big cities shrinking at a small came to basically a very small rate in 2022, but I don't see any prospect for this increasing. McKinsey Global Institute did a report in which it said hybrid work is here to stay. Office attendance has stabilized at 30% below pre-pandemic norms, and that has been a big problem for urban cores, places like New York City, Chicago, San Francisco, and of course, Washington, D.C. So what we decided to do was invite three people with very different perspectives to talk about this today. And because we only have 4 chairs up there, I'm going to moderate from here. That was planned. Natalie Cohen started her career at the New York City's budget office, worked on a number of different capacities, most recently 8 years at Wells Fargo, and she now has her own firm. James Guide is the research lead for local economic development work at the J.P. Morgan Chase Institute, where they've recently done some work on this, which is why we invited him. Jessie Hanbury is an associate professor of real estate at Wharton, and she has recently co-authored a paper on residential property values here. And then to keep us all grounded, we invited Glenn Lee, who's the Chief Financial Officer for the District of Columbia. He's been here since August of 2022. Before that, he spent 28 years on the payroll of the City of Seattle, the last dozen as its finance director. So I'm going to start by just asking each of the panelists a leading question, and then we can have a hope of conversation and involve as many people in the audience as we can before we run out of time. And Jesse, maybe I can start with you. In the work you did, you found that the first 2 years of the pandemic led to an initial plunge in downtown residential property prices, which was followed by a rebound, but suburban residential prices kept increasing. And I wonder, could you talk a little bit about that work? And more importantly, do you think that's going to continue, and what are the implications for city revenues if it does?
Sure. Well, thanks so much for having me. I'm looking forward to learning a lot.
So you got to pull the microphone a little bit
closer. There we go.
Great.
So the work that I did with Gilles Duranton in my department at Wharton was basically trying to think about what the impact of COVID was going to be long-term on cities. And we started by sort of pulling data or results from other papers, and the work that David's referring to is pulled from a paper by Romani and Bloom that was looking at how prices change differentially downtown versus in the suburbs and cities, and then across different cities in the US. And what's interesting there is the trend that you're referring to, this collapse in prices and then subsequent rebound, was in rental prices. And there's a distinction between what we saw in rental prices and actually house prices. So think about it as the price of space for a year, for example, versus the price of the asset, where you're sort of buying that asset and the opportunity to earn rents over the long run, or the opportunity to live there over the long run. And so when we were looking at rents, we did see this collapse and subsequent rebound, which had a lot to do with sort of people leaving cities and then coming back sort of in the immediate aftermath of COVID. And we saw that rebound by the end of around 2020, when rental prices converged a little bit with suburban prices. And then since then, at least through to the end of 2022, have followed a pretty parallel trend. So think of it as like a level shift in the demand for space downtown. On the asset price side, however, if you look at house prices, hard to tell what happened up front because there just wasn't a lot of liquidity in that market. But what we've seen over the past few years is a continuing divergence of the trends. So we've seen suburban prices, price growth outpace urban or downtown price growth, which is pretty worrying if you're thinking about that those asset prices, what differentiates them is the expectations for future rental growth. And so those expectations are weaker for downtowns than the suburbs. And in our paper, Gilles and I basically attribute this to work from home as being the lasting impact of COVID in terms of its impact on cities and real estate. And it's increasingly becoming clear that work from home and remote work is going to persist. And this sort of shifts what had been sort of the balance of power that had been really shifting towards downtowns back towards the suburbs in terms of where demand growth is going to be and asset price growth is going to be. So James is going to talk a bit about sort of what all of this means and work from home means for businesses, but which is perhaps less clear. They have sort of this really novel, nice data on it, but for residential patterns and property prices, there is this sort of growing divergence that is going to have immediate impacts over the coming years in terms of property taxes. Those are slow to adjust. I'm expecting that the impacts on municipal financing and revenues have really come thus far in wage taxes and business taxes, transaction taxes, but I'm looking forward to hearing from
And is there a lot of heterogeneity across cities, or is it a general pattern?
Yeah, think of this as being a lot of the patterns that I'm talking about as being a top 10 big city phenomenon, because what we're thinking about as driving this is the fact that, individuals, when they have the opportunity to work from home, want more space in their home. So they're more sensitive to house prices. Right? And so this is more of a factor where you can't afford to, upsize, add another room in a smaller metro versus a big metro. So it's your San Franciscos and New Yorks that, are really suffering from this.
James, I wonder if you could first give the very short explanation of what JP Morgan Chase Institute does, what data you work for.
Of course, thanks.
And then we'll charge you for the commercial later. But You did this interesting work about retail establishments and how they have paralleled the movement of residents from large, expensive cities into smaller Sunbelt cities and from city centers to suburbs or with neighborhoods within the the city because of the exposure because of the adoption of work from home. So tell us a little bit about that. But first, tell us what the hell is the J.P. Morgan Chase Institute?
Yeah, so relatively new organization within J.P. Morgan Chase, and we use the bank's transaction level data on consumers, businesses, investors to do public policy research. So, I would invite you all to check out the various research streams we have, right? I work on just one, our local economic development stream, but there are many other teams doing really great work. Or please come talk to me afterwards if you'd like to know more. Our comms team has printed out some nice handouts for me to give afterwards. But yeah, so one of the things that we did with this pretty novel data was to look at storefront openings and closings in 16 major metro areas across the U.S. And at the city level, kind of what we found, and I say we here because my co-author Lindsay Relihan, who isn't here today but is really fundamental to this work. She's currently at Purdue. We found that places like San Francisco, LA, New York, right, at the city level were the big losers in terms of establishment losses, right? While cities like Houston, Dallas, and Phoenix had the highest growth, right? What was also, very obvious to us after we looked at how population change in these places was that there was pretty tight correlation that, by the way, didn't really exist pre-COVID, right? And that was something that struck us as we were looking at these relationships before and after the pandemic, right? I know you had asked, what might explain some of these cross-city differences. That I think we're less sure about, and we did focus more on the within city patterns, right? I think a lot of the literature that we relied on, right, again, which you will find in Jesse and Jules' paper, pointed to the relative importance of within city moves. But, looking at kind of a very high level at cross-city differences, one of the things that, we did see is that these cities, San Francisco, LA, New York, were really exposed to work, high levels of work of residents who work from home, right? As opposed to jobs that could be in remote ready positions, right? And that was an important distinction that we found, is that the new work from home patterns kind of would work at the kind of consumer level and not just at characterizing areas where there's a lot of these kind of jobs. So what we found was while population kind of continued to decline in downtowns, right? We saw initially that this was matched by establishment declines in those areas as well. Drawing out that time series, though, we noticed a kind of a meaningful recovery, right, as you pointed out, in downtown areas. While it seemed like suburban growth had hit a ceiling a bit, and I think this raised a question for us that we still haven't answered, and that's whether there is some limit to how much suburbs can densify, and if we are actually going to see just kind of swapping out of the levels, or if there's just going to be kind of overall lower levels of establishments because there are these kind of upper limits.
And with the within city stuff, I'm assuming that what happens is that the retail establishments are moving to the parts of the city where more heavily residential, where people are working from home, and the problem is in the core places like where we are now, where there's not that much housing.
Yeah, and what we found when looking a bit further is that it's not necessarily just the fact that the core is in the center. It had to do with population growth, right? So there might be places that are in the that are technically like within the core geographically, but they didn't experience a lot of population growth, you might not expect them to lose that many establishments.
Yeah.
And this is where I think like looking at what's going on in the housing market, are there places available for people to find this extra space that they might have been looking for as they work from home, if those areas are available within kind of more urban cores, you might not expect there to be as much losses. But that remains to be seen.
So Glenn, let's take DC as a case study. Talk a little bit about what you see in DC and what are the financial implications for the city's revenues.
Sure, and thank you for inviting me.
Oh,
it's good to be
thank you
with
for
all
coming.
of you. I think we see two significant issues. First is a substantial decline in the number of people occupying our office spaces. They may still live here, they may still live 10 miles from here, but there's a dramatic decline. The second is our population has declined as well, about 40,000 people over a 2-year period, or 6%. We're not recovering, but we're not going down any further, at least so far. Let me drill into that a little bit. In terms of workers, the district supports about 770,000 jobs. Literally hundreds of thousands of people commuted in every day pre-pandemic. But now we see that offices are occupied at less than 50%. And of course, with less occupation of offices, their value declines, and that ultimately leads to less property tax revenue. And our current estimates are that we're going to be losing about $220 million per year in property tax as a result of this phenomena. And that's on a base of our local government fund of about $10 billion. So it's well over 2% of our revenue stream now that we're not planning to have. And the council and the mayor have balanced a budget for not having those resources. But we're really interested in what's happening in the leasing market. Of course, that drives the value of properties. And from 2019 until now, unleased properties represented originally about 11% of office spaces. Now it's up to 16% at the latest data we have. So we estimate what would happen, we've estimated what would happen if it reached 20%, because there's plenty of anecdotal information that vacancies will continue to go up as firms face new leases. At 20% unleased, that would add another 70 million or so. So we'd be close to $300 million a year of less property tax revenue. Again, that's about 3% of our local government resources. As I said, the peak to trough loss in population is about 40,000 people. It's about 6%. And that comes after 20 years of solid growth, between 1% and 2% a year. It's clear that there's a high correlation between population growth and the district's financial health, largely because of our fairly progressive income tax system, as well as the property tax on residential properties. The actual performance of our transaction taxes and income taxes is masked by some short-term issues, so we've actually recovered to pre-pandemic levels, but the trend is not in favor to continue at that growth rate at all. Finally, I'd like to bring up not an issue that we actually directly manage, but we have a heavy reliance or dependence on, and that is the local metro or train system here. For us locals, we know it's called the WMATA system or metro system. They too have faced the dramatic reduction in use. I think they're at less than 50% use right now on the trains, and therefore they have 50% loss in their fare box revenue. They've just balanced their current fiscal year, which started a couple weeks ago, on essentially hundreds of millions of dollars of one-time federal money. So in July of next year, they estimate they'll have an operating deficit of $750 million per year, and that would reflect about 30% of their operating budget. So why is something I worry about? Well, the district is part of a three-state relationship compact to support and subsidize the system. And so we're now in a position of having to backfill between us, Virginia, and Maryland, this loss or lose system capacity, dramatically lose system capacity. So we're pretty concerned about this, probably my number one concern right now. Not only the revenue or the economic hit to the region, but also just the budget hit. We're going to have to figure out how to fund this. So what is the district doing? The mayor and council have some programs to subsidize firms that want to come into unoccupied office space, subsidize some conversion projects of taking office space and converting it into residential, and then trying to bolster a lot of street activity, so different fairs and events, farmers markets, and somewhat. We hope that's successful. It's hard to estimate its impact, but they're working hard at it. So.
And how much of a factor is the federal government's very slow return to work?
It's substantial. Between 25 and 30% of workers in the district are federal employees, and well over half commute every day. So probably, at least what reports I've seen, relative to all other employers, they're the least in terms of proportion who are returning.
Right.
And so we're concerned a couple levels. First, we need more people in the city to come back, but also, as reported by the federal government just a week or so ago, they have a lot of leases for office space here in the district that are coming due, well over half in the next 2 to 3 years. They're receiving a lot of pressure from Congress to terminate those leases, which will have an immediate increase in the number of unleased properties in the district.
Yeah, there was an interesting episode where the mayor called on the federal budget to make federal workers come back to the office, and our local congressperson, who doesn't really have a vote, said she endorsed that until she realized that a lot of these people were her constituents. They didn't want to come back to work, and she then reversed herself. So, Natalie, when I think about what this means for the municipal bond market, it seems a little gloomy for for cities that have lost population or are seeing declining property values or were struggling with other problems before and now have to worry about this. Is this showing up in the market yet? Is it something that you worry about relative to all the other things to worry about in the municipal bond market, including the great quality of disclosure, which I've learned a lot about from Mark, inflation, rising rates? Well, on the other hand, there's all this federal money flowing to cities from all these things. So how does this fit into that picture?
Right. Is this on?
Yeah.
Yes. Okay. So just to touch on a couple of the comments that were already made, I've been following the commercial office. There are a fair number of bankruptcies. I would say there are, and this is downtown core type of office buildings. In a way, there have been a number of people landlords giving their keys back to the lenders, which was, in the Great Recession called jingle keys. And there's a little bit of that going on in commercial real estate now, which absolves the owner of actually defaulting, but now it's a bank problem, real estate owned. So a lot of the media has focused on the banking side, but which the regional banks are high owners of commercial real estate. And given, what we saw recently with SVB and Signature and Republic and so on, that is a concern that could start to roll out and when it stops being, real estate owned and actually a defaulted credit that has to be written off. So yes, that then translates into lower values and lower property revenues. But taking it to a little higher level, the geographic structure of large cities has been a hub and spoke for a long time, many decades. And so that model is now kind of being blown up. On the positive side, in many cities, not just the largest ones, there's a relocation geographically of the activity. You have pockets, and I'm in New York, so I'll relate Brooklyn and pockets in smaller cities where, like Pittsburgh, for example, where a lot of young people went for jobs and lower cost of living. that you see those pockets of activity. The restaurants are filled, even if they're these, I call them cabana type, exterior housing because of COVID. So you see that kind of activity. It's flourishing in those areas, so it's kind of relocated. But that obviously does significant damage to major transit systems. And if you're looking at suburban growth, just to flip to that, reconfiguring transit, going from here to there, how do you figure that out? It's no longer a hub and spoke. Your John Hamm madman is, that model is over, where it's obsolete a lot. But again, looking back to history, we've survived these very major shocks and changes. If you think about the 70s, there was white flight from the major cities, the urban crisis, and we had globalization where technology allowed companies to disaggregate what functions were done where. So the headquarters may have been in the major city, but the production may have been in Mexico or the Far East or somewhere else in the world. And then you had the 1990s. A positive side was that as industry moved out of the cities to other locations, at least in New York, and I can think of New Orleans as another example, you had a move-in of an artist community. You had the loft spaces that were taken over by the creative groups of people, and that breathed life into those areas. So there was definitely a downturn followed by a rebuilding. And a final example, just coincidentally, a longtime colleague of mine who's been involved in real estate and development in the city shared a draft study of the rebuilding of the World Trade Center site after 9/11. And obviously that took 10 years, 20 years, 15 years, pick your number on what stage of development. But it did happen, and it did create this incredibly vital downtown. And the commercial office buildings in the financial district, many of them were converted to residential. So we need residential. The issue is the will of the politic to say, we've got to change zoning, we've got to help the transit so that people can get around. And permitting, which was discussed, I was happy to hear that yesterday, that some mayors are thinking about that. That is slow, grunting, hard stuff to do. And on top of that, the response when I talk about this is that it's very costly to convert some of these older buildings. You've got to do a lot of fixes, a lot of changes to the electrical systems and how the spaces are structured. New York City offered some significant tax credits on that front, and it did eventually work. I know there's a lot of complexity to that discussion, but it did convert many of those older buildings that are very charming into residential. So if you walk around the financial district, it's got that kind of residential life to it.
So are big city municipal bond yields affected by this, as best we can tell? Or?
Our big city, well, I would point to rates as more of the
Right.
issue. It's really a rates-driven market, and I did pull, in case you were going to ask that question.
That's why I invited you, Natalie.
I did pull some of those statistics, and from 2021 to 2022, there was a $100 billion drop in volume. From 2022,
In what of all municipal bonds?
rates related.
But are you talking about the whole muni bond market, or just
Yes,
big?
the whole the new and refunding and total package. Obviously, refundings fell away because they were no longer economically sensible. But from 2022 to 23, we've had further declines, and it's continuing to go down. So in the first quarter, almost a 25% decline in volume. Again, this is total. And then second quarter, about 16% decline in volume. So I looked at what was declining and what areas actually showed some growth. Unfortunately, higher education is really way down. That's significantly down in terms of facilities and so on. I think higher ed, for a lot of reasons, has some, fixing to do, so to speak. In terms of positive, VRDOs came back, obviously, because rates encouraged that, and so that sector has shown some growth. New money is, sorry?
This is an acronym-free zone.
Oh,
What's a
sorry,
VRDO?
variable rate transactions. So, variable rate makes more sense when you have that kind of spread and a higher rate environment. It was so compressed during the zero bound of the Federal Reserve for so many years that a taxable refinancing of tax-exempt money made sense. So we had a lot of refunding of debt in the last couple of years that went taxable. So that was kind of another interesting distortion. I think that's going to continue. I mean, I was surprised when, during the various phases of the stimulus programs, that there was such excitement about how the muni market was going to grow. And I mean, I can't distill what was rates and what was, what was the impact of COVID and so on. But it really, or the stimulus programs, the stimulus money that was coming into state and local government displaced a lot of that
Right.
type
Yeah,
of
I got the
borrowing.
feeling yesterday from the mayor of Richmond that they
Yeah.
borrowed less.
And he was explicit about it.
Yeah.
Yeah.
So Jesse, I'm trying to figure out whether this could actually lead to a new equilibrium that's good. And I say this as a father of a guy who lives in San Francisco, and when he had a cold, he decided to look on Zillow about buying a condo, and it didn't make him get better quickly. So you take a city like San Francisco, just an example. Housing prices have been a problem. Demand has been very strong. Supply is ridiculously constrained. Does this, if the prices fall, does this mean more people come back in and we solve the problem that Glenn talked about population? Or is that just a naive chapter 1 of an econ textbook kind of view of the world?
I think in terms of population growth, it's going to be a long path to coming back to growth. While there's the reallocation of that James talked about and Natalie talked about in terms of businesses, my sense is that a lot of the commerce that's happening in downtowns, so your non-tradable services, your bars, your restaurants, your gyms, like, can a Soul Cycle survive when people aren't downtown 5 days a week? Probably not. Those types of services are going to fall away. What does that mean? That means that because you just don't have that office foot traffic.
Right, so then you have fewer amenities and people don't want to live there.
So then you have fewer amenities and people don't want to live there. This is good from an affordability standpoint, so indeed, right? To the extent that now a different profile of resident can now reside downtown, perhaps a more creative profile that really values the interactions that they can have in a downtown area. There could be some sort of renaissance or rebirth, and downtowns could take on a different sort of bit less of an office profile and a bit more of a consumer city profile. That would just take time. The conversions that Natalie was talking about are expensive and will take a lot of time again, and there'll be some pain. I think on aggregate, my sense is that downtowns will just be, a step below on the suburbs now. And so that's the new normal.
Yeah.
And I think also when you're thinking about, aggregate, are all of the municipal revenues that were being earned from all the businesses that were downtown going to move to the suburbs? Probably not, because the scale economies in the suburbs and you don't have the same density there.
Yeah.
So I just think that, we need to get used to. I don't have a super optimistic view, but I think that there are potentially some distributional changes that are positive.
James, so what else did you learn in your survey of retail establishments that you found interesting or surprising?
Maybe to follow on from Jesse's point, it's possible that working from home doesn't just change where you're doing your shopping, but what you're shopping on, or how you are consuming, right? One of the things that we saw was that if you look at where establishments were growing by product, we saw that, okay, yes, it looks like, yes, grocery stores are kind of matching population growth in the suburbs. That's not happening with restaurants, right? In a way that it didn't look like people would just move out to the suburbs and then completely substitute, or completely just retain their consumption patterns.
Right, they don't go out for lunch when you're working from home.
Right.
Yeah.
And yeah, for us, that was something that we thought was worth calling attention to, because it does have implications for sales tax receipts, for employment, in these different areas. And then to the extent that your suburbs might fall outside the jurisdiction of your city, I think that is also an important.
So what's the work from home situation at JP Morgan Chase Institute in DC?
So right now we're in 2 days a week. That's going to go up to 3 in August.
And are people happy about that?
They're thrilled. Yeah.
So Glenn, I want you to respond to anything, but I wonder if you could talk a little bit about whether you think there's potential for office to residential conversion in the district. There's been a few of these. It always looks to me like a great idea in principle, but the idea of putting the plumbing and everything, some places I've seen the conversion means basically gutting the entire building, and the only thing that's left is the walls outside.
Right.
And we have some incentives in the district for this now, right, or not?
Some, but I'm not an engineer. I'm an economist, so I'll talk about finances. I think, and governments, first, there has to be a lot of zoning and building controls adjusted, and someone mentioned that. I think that actually is a painful process. It'll take time in any jurisdiction, whether DC or not. The second is, in reality, private capital needs to flood these markets to really make up the difference. That the public sector isn't going to be able to incentivize several $100 million conversions in their downtown core. And I'm not sure what sources of that capital could be. Many of real estate investment trusts, of course, have been hit very hardly, or have had difficult times, so whether they have the resources or not. But that's really the solution, is for the private sector markets to respond to that, providing capital, from my perspective.
Right. It seems like a bit of a problem if there's not the demand for the housing downtown. The economics of spending a lot of money to convert.
Right.
Challenging.
But large cities will only have a couple shots. They'll only have resources for a couple.
Right.
To really incentivize effectively a handful of development, and that won't nearly be enough to offset the other losses.
Okay, I can keep going, but I want to turn to the audience to give you a chance to answer questions. You want to start off here with Mark, and then over here, and then Mr. Wamata.
So right off the bat, Jessie caught my attention when she used the words balance of power. There has been, for probably 100 years, a struggle between neighborhoods and downtown was always on top. I wonder, she mentioned suburbs, but within a city like Kansas City or a city like Detroit or a city like Pittsburgh, it's the neighborhoods versus downtown.
That's a good point. And I should have asked, that's Mark, that's from ex-governing magazine, ex-mayor of something. Where were you mayor of?
Kansas City, Missouri.
Kansas City, Missouri. Introduce yourself.
My name is Johannes. I work here at the Federal Reserve of the board here in DC. So what I find interesting is this asymmetry in what kind of cities were hit by the pandemic and by the permanent work from home that we see right now. So you mentioned that the places that are hit are DC, New York, Los Angeles, etc. Like we heard yesterday that, for example, Richmond, Albuquerque, etc., are doing much better. So I wonder what distinguishes these cities. Is it those that had a hip urban downtown area that now just has become really unattractive, or is it cities that provide more public services which are suddenly not in demand anymore? what's going on here?
And also, I think there may be some relationship to attitudes towards COVID, that some places didn't get a big hit because people didn't take COVID seriously, so they didn't all bunker in their
That's a good point. Maybe that correlates with having a hip urban downtown area. I'm not sure.
So that's absolutely what's happened, where people moved out of the larger, more dense, looking for less dense because of COVID. But I think there's also, and this is just a hypothesis, a lot of movement, say from New York City, went to Palm Beach and West Palm Beach and Florida and so on, and other places with lower density, smaller cities are growing and now have to deal with growth issues. So there's definitely that kind of asymmetry. But there was all kinds of news and discussion about the wealthy folks that could no longer go to the high-end restaurants and the theater and so on, of moving out and just saying, this is why I've suffered New York for so many years, or why I suffered San Francisco for so many years. I'm out of here. And it's a hypothesis as to why it seems like the states that have no income tax, no state income tax, are the recipients of these migrants. Untested, I look to all of you statistical wonks to come up with the right analysis of that, but that seemed to be the case.
Helen, guy right in front of you.
Hello, Leonardo Meyer, WMATA. I had a quick question for Glenn. You were talking about solving, of course, this operating budget shortcoming with WMATA, but it seems that this private investment and conversion of these office spaces into residential seems to go even further from this hub and spoke model that it seems like this transit is relying on, right? And I was just wondering on how you would solve that, and it seems like, yeah, maybe those like fares and whatever would return more to this hub and spoke commute model. So yeah, I would just want to know about that.
I don't know whether changing fares on the transit system would encourage people to commute every day again. I agree with a panelist here that we are moving, it seems, away from a very intense hub and spoke environment that certainly intensified over the last 20 years in North America, from my perspective. And unwinding that, including transportation systems, is really the challenge of our time, from my perspective.
I guess it's an advertisement for buses.
Mm-hmm.
Yeah. Dan?
Dan Bergstresser, Brandeis University. Yeah, both yesterday and today, I've gotten a little bit nervous when I hear people talk about making it easier for developers to build or to transform buildings, because when you look at earthquakes in places like Turkey, everything kind of falls down, and I worry if we're being a little bit too cavalier sometimes about the benefit of the bureaucracy, when that bureaucracy makes sure that, ensures that residential buildings are durable. You just shook your head no.
Go ahead.
I can't imagine that any city would adopt net new building codes that would put people in jeopardy, and I'm advised by my attorney to say so. So I'll leave it at that. But the reality is, it depends on your tax structure whether in the long run that helps your government and its services sustain or not. Here in the district, we have a fairly progressive income tax, which means more population generally provides more resources for our services. I came from a state without an income tax, so growth didn't necessarily mean more resources to provide the basic services. And so that's my answer to your question. The safety issue, of course, is always an issue.
And also, Dan, it seems to me there's a difference between saying the permits take too long to get and the standards used to grant them. And the district has made some progress, but it's pretty easy to get someone in any group of people from the district to talk about how long it took to get a building permit. and it wasn't because they were making earthquake-sensitive additions to their houses in Upper Northwest. Mark, over here, and then the woman behind you. Mark, raise your hand so she can find you for the mic.
Mark Steinmeier, Smith Richardson Foundation. I want to go back to the variation among cities. And while the attention's on New York and San Francisco, those cities were doing so well that the magnitude of the fall is striking, but they have room for error. What about, Buffalo, Milwaukee, these places that maybe were not as vibrant, but just losing even a smaller percentage of their downtown core revenue is going to be have a greater impact?
James?
Yeah, I might have to pass that one off to some of the other panelists, because one of the things that we did in our study was we're limited by places that Chase covers, right? Because we're using Chase transaction data to do this, and then we also want to limit ourselves to where Chase had like really good coverage, and so this is like kind of limits the study to these major metro areas. So, from an empirical standpoint, I can't comment too much on those cities that were out of our sample.
Natalie?
I was just going to comment that, yeah, there is trouble out there in some of the smaller cities, and you mentioned Milwaukee. There are some fiscal and, existential issues around that city. Buffalo, I'm not that as familiar with, but for sure, upstate. There's been industrial development in upstate New York that has helped that environment, but they certainly have lost a ton of industry that used to be there.
I think Mark's point is, if you were already sort of on the edge, you didn't need any extra help.
Is it going to tip
Glenn,
you over?
Could you talk a little bit
possible,
about
yeah.
Seattle and what's things like there? You don't work there anymore, so you can be honest.
Yes. It's a real challenge, primarily because I think the main employer is the industry of high tech. Within my term as city finance director or CFO, a large employer that we all know added 55,000 employees whose mean salary was well over $300,000 a year within 4 blocks of my office. And so there was a dramatic impact on the economy, but I understand that those workers and their work was more adaptable to leaving. And so you've seen that particular firm multiple times saying we're coming back, but they can be perfectly productive and profitable without that. We have other major firms in the same area, and I think San Francisco suffered the same. I don't know about New York, where Salesforce.com, Microsoft and whatnot, the nature of their work allowed people to be more remote than a law firm that had 100 years of approach to things. That's just speculation on my behalf, but I think it's borne out in how performance has worked in many cities.
Okay. Sadie Bograd, Tax Policy Center. All this conversation about zoning and permitting is making me think of the very common backlash, whether NIMBYism or other forms of retaliation to most proposed changes in development. And I'm not sure how much any of you can speak to this, but I'm curious if you have a sense of what the public reaction has been like, either to increasing development patterns in suburbs or to some of these proposed office residential conversions in downtown areas.
I just want to bring something back that's in part in response to your question, and it's an observation that there's a correlation between the sort of the Florida locations, the Texas locations that we think of as having, maybe low income taxes, and their zoning policy in terms of, suburban zoning being more free there. I think they're the cities that, or they're the locations that gained a lot. So I do think there is sort of NIMBYism, and zoning restrictions are sort of constraining, as James said, some cities up in, particularly the northeast, northwest, from, surviving or thriving.
But both the mayors yesterday talked about ADUs as being popular. Now, that's not going to solve a $40,000 unit shortage in Richmond, but it's interesting that seems to have become politically acceptable. Luis?
No one's mentioned business travel.
Introduce yourself.
Sorry, Louise Shaner, Brookings. I'm just wondering how big business travel is, especially for these big cities you're talking about, how much lower it is, and whether or not that's, whether or not you think that's going to come back.
So I think the hotel occupancy in DC is pretty good, right?
Yes, it's almost at pre-pandemic levels. And certainly on a gross sales point of view, both restaurant sales and hotels are up. I think what's unique is, as I'm learning, DC is a very different destination than any other major city because it's our capital. And so we've been fortunate to continue a large amount of a good recovery in business travel as well as tourism here. But I'm not sure if that is unique or across the country.
It's definitely true in New York. The tourism is up. I don't know what hotel occupancy looks like, but it's probably neighborhood by neighborhood because there are so many pockets of activity. But once Broadway reopened and, the movie houses reopened and some of the stores reopened and so on, it's flooded with tourists in certain areas.
So you're sort of implying that tourism is up and compensating for some of the weakness in business travel. Yeah, the revenge travel.
Mm-hmm.
Yeah. Eli?
Hi, Eli is Dorian Hutchins. So the last time American cities lost a lot of population in the 60s and 70s, it was blue-collar manufacturing jobs, and many of those cities were just permanently gutted and never recovered population. But it seems like now the cities that are losing population are losing white-collar workers because their white-collar job hasn't gone away. So I guess I'm wondering if all of this population loss really has implications for whether or not these cities remain the economic powerhouses of the U.S., right? Like, do New York and Boston, et cetera, still stay the center of economic activity if the jobs haven't left?
Very good question.
Jesse's moving her finger towards the button. So she
I've done some research on sort of the trends in the 60s and 70s, and then actually a lot of those cities had rebounded and come back, maybe not in terms of overall population, but in terms of the income distribution by 2010, 2020. I think that one thing that that's important to note is, yes, there are some moves between states and out of cities entirely, but I think someone's already mentioned a lot of jobs are still people are going in 2 or 3 days a week. You can't commute, or some people do, but you can't really feasibly fly somewhere or commute 8 hours to go into a job 3 days a week. So I think, you're still going to see, I don't think, as many large firms are moving their offices. They're just saying people can work remotely, X number of days a week and come in fewer days. So I'm not sure that we're going to see that shift so much.
I'll bring it back to this issue of downtowns. That kind of 2 to 3 days a week might be enough to sustain kind of some businesses downtown, but maybe not the level that there was previously, while also keeping office buildings occupied and less fewer buildings able for the renovations remodelings that a couple of people have talked about. Exactly. So it'd be interesting to see how that kind of in between in between level of occupancy changes things.
Yeah. Okay. Well, I want to thank our panel. It's an interesting conversation. I kind of feel like we have to wait a year or two to see how much of this is lasting. Again, on behalf of Washington University, Brandeis, and the University of Chicago and Brookings, I want to thank all of our participants and all of you who came and asked such good questions. It's always a good sign when there are more questions and we have time to answer them. And I want to thank our research assistants who are very good at the timekeeping, which helped us squeeze in an enormous amount of time, an enormous amount of content to a limited amount of time. I should mention that the Municipal Finance Conference has an advisory committee of people from a variety of backgrounds, which is very helpful when we get a lot of paper submissions and we have to decide which ones to accept. So I want to thank them and remind them all that we have a meeting scheduled on the second floor here immediately after this conference. But thank you, Glenn, Jesse, James, and Natalie.